Better. Could we come to order? The bells are ringing. 30-minute bell. So we should be able to get the presentations in before we go to vote, and then we'll come back and do questions. I know you people asked you one issue to deal with first. Yeah, you folks.
Thank you, Mr. Chair. Obviously, we're very happy to hear that there's been such interest in this topic. This is important for us as parliamentarians to deliberate on some of the policies of the government. So if we are going to be adding, which I understand we are going to be adding, how much time, Mr. Chair? Two meetings?
One meeting.
One meeting, 4 hours?
We were thinking 3.
3 hours? Okay, would that cover everything? Because after talking to my colleagues today, we also figured that due to many of the concerns that were raised and the fact that so many of the officials from different government agencies weren't able to speak from a holistic sense on the importance of the issues, perhaps we might want to have the Minister of Finance and his officials come in so that they can basically, answer many of the questions that many parliamentarians, I think from many different parties, have about the mortgage changes. I think that this would probably clarify in the minds of Canadians quite a lot.
So it's your suggestion at the moment?
Oh, well, you know what? It was your suggestion, so I'm suggesting along with you that if we do that,
not my
so maybe.
suggestion.
Well, no, you suggested the other day.
Here.
So we have another meeting. Can we add the Minister of Finance to it? I think it would be helpful.
I think the only way we could deal with that if there was a motion to that effect, and if you want to give us notice of that motion, we can deal with it.
Well, are we talking about the business of adding to it? Wouldn't that be part of that?
Yeah.
Okay, so I don't need a motion.
It would require an extra meeting. We have the 3 hours, which are witnessed up.
Okay.
I mean, if you want to propose notice of a motion to have an additional.
Well, would I need notice of motion, Mr. Chair, since we're already talking about the subject?
I think it's the same study.
So I don't think I would need it.
Yeah.
Great. Okay. I make the motion that we invite the Minister of Finance to bring along his officials to discuss many of the housing issues, particularly the mortgage policies and perhaps some of the other policies that he's currently consulting on.
Okay. Motion's before you. It's up for discussion. Any thoughts?
Well, I certainly don't see any harm in having the minister present.
We'll call on you.
I met with.
We'll call on the witnesses later. This is internal to the committee at this moment. It is a public meeting, and that's fine. You have the right to put the motion. Is there any Mr. Sabera?
Thank you, Mr. Chair. Thank you, my colleague on the other side there. I think when we've heard from CMHC and OSFI and Department of Finance, we've heard from the participants in the market that would know what is going on within the housing market, and having the minister here is just not necessary. He's been here a few times and he's been very thoughtful with his time with us, but having the CMHC, which is oversees the insured portion of the housing market, has been more than sufficient.
Okay. Any further discussion, Mr. Leibert?
Well, I respect the members of the government trying to protect their minister, but with all due respect, we had no answer by the officials the first day as to how this policy was developed. We then had a series of witnesses who said that there was no consultation. So I think it is incumbent, if we're going to do a comprehensive review of this decision, that the minister, and if it doesn't work for the minister, we will have to accept that. But for the government members to refuse to agree to invite the minister, I think, is appalling. And so what I would suggest is that our colleagues on this committee agree that the minister be invited. Hopefully he can make it. Surely his officials could make it, because I think it is important to get a better sense of how this policy was developed, because it obviously was not answered by the first panel of witnesses. And at the same time, Mr. Chair, I think if we're inviting witnesses, I do believe we agreed the other day that the CEO of Canada Mortgage and Housing Corporation should be invited back. Unfortunately, he couldn't make it the first day, and we understand that. But I really believe that it's important to invite the minister and let him make that decision, not his colleagues who sit on this committee.
Just on that point, we have invited the CEO for Canada Mortgage and Housing. He is unavailable on the day we're holding the meeting, which is the 8th. We'll go to one more comment from this side, and then we're going to go to the question.
Thank you, Mr. Chair. Nobody's refusing to invite the minister. In fact, I'm quite happy to support the invitation to this committee. However, let's just clarify a few things. There was no suggestion that nobody was consulted. In fact, there was testimony that there was consultations done. Also, we heard about the proposed risks to the system and the reaction to that. And that is always in the government's best interest, is to respond and react to market conditions. So I look forward to supporting this motion and hearing from the minister and officials on just how this policy came to be and how this will help Canadians.
All right, we'll call the question. All those in favor of the motion? Opposed? Motion's carried. We will extend an invitation to the minister. Turning to the witnesses, we are here to...
Excuse me, can I make another point? Just as a matter of moving forward, the parliamentary secretary is not a voting member of this committee.
Yes. Oh, sorry. It wasn't counted, Mr. Leipert, sorry.
Just briefly, Mr. Chair, if you can clarify, you've said that we're going to have another meeting. I think that that's great. You've also said there's a lot of people who'd like to come, and now we're actually re-inviting the current president of Canada Mortgage Housing Corporation and the minister. To me, 3 hours to hear from both of those and some of the other people may not be fair to the witnesses. You may want to consider extending that meeting, or perhaps because we want to be flexible for the minister and the president, perhaps we add another day.
I would be awfully surprised if the minister was able to come on that short a notice, but we will we'll extend the invitation and see what we can do. If we have to set up another meeting to have the minister, we may have to do that. Turning to the study that we're on in terms of the Canadian real estate market and home ownership, I thank the presenters from coming forward. We are going to be under a bit of a timeline, and we may not hear from all of you before we go to vote, but we will be back. So we'll start with the Canadian Mortgage Brokers Association. Mr. Soni, who's the national president. Go ahead.
Thank you, Mr. Chair, and thank you to the committee for inviting the Canadian Mortgage Brokers Association to speak about the current situation in the housing and mortgage finance industry in Canada. As mortgage brokers, our members are uniquely positioned to offer insight into the industry. Our footprint in Canada as mortgage brokers is very extensive. As an example, mortgage brokers fund over $70 billion a year in mortgages. That's the level of activity. And it's all types of mortgages: residential mortgages, commercial mortgages, development and construction mortgages, refinancing, debt consolidation, apartment buildings, rental properties. It's very extensive. In fact, over 55% of first-time homebuyers use a mortgage broker. Imagine a mortgage industry without mortgage brokers. We also distribute funds for alternative sources of financing, such as Mortgage Investment Corporation and private mortgages. So we have a level of knowledge that we're very happy to share. We understand the unique challenges that Canadians face when it comes to home ownership. Our members live and breathe these challenges with these homeowners and these potential homeowners. And this happens throughout the country. We like to say that mortgage brokers are the tip of the spear when it comes to home ownership, because we make that dream of home ownership a reality for many people. When it comes to the issue of home ownership costs, that tip of the spear is a culmination of many costs that result in an end price for a home. There are many, many factors that determine pricing, and many people seem to be alarmed at what is perceived as a high cost of home ownership, which also goes into the high cost of rents, because somebody has to own those properties. Ultimately, these costs have to be paid, and that's where we're at the tip. For most Canadians, this is paid for by taking out a mortgage. It's that simple. As costs increase, your mortgage amount will increase as well. As I've said, many observers and Canadians are alarmed at the high costs that they face or perceive a high mortgage amount that's required to own a home. So it's very important we understand those costs. Those costs, and we've submitted a letter to the committee. There's many factors. We know there's always the land cost, but when you look at development, there's changes in the building code every year. This increases costs. We don't build the same type of home we built 20, 30, 40 years ago. We're always building a better product. That costs money. That results in possibly a higher mortgage amount for somebody. Municipal fees. As mortgage brokers, we're involved in development financing. We see lots of different costs in different municipalities. These costs are development cost charges, school fees, land acquisition fees, land dedication fees. All of this actually adds to costs. Municipal bylaws also add to costs. There's a requirement, as I said, for land dedication. We're looking for livable community concepts. Urban planning professionals build better communities. These all cost money, and they culminate in the end price of homes for Canadians. And there's also a slow and frustrating development process that our developer clients see. They have to pay for that. Holding property costs money. They take out mortgages, their interest costs accumulate, and they have to pass that on to the end purchaser. So we do understand how these costs are manifested, and we are at the end financing Canadians, and we understand that. What we like to say is that there's also finance costs involved. We've seen recent changes to CMHC's insurance premiums, and in our letter we've actually submitted some examples, and we can refer to that in the question period. But in some cases now, the insurance premium is as much as the down payment that you've actually asked the homeowner to put down. So as an example, on a $500,000 purchase, 5% is the minimum down payment required, $25,000 as a down payment. In an extreme case, you'd pay about $22,000 in insurance costs. So that's a very onerous cost at the end of the line. Canadian Mortgage Brokers Association would like to offer our consultation services and let you know that we are experts. Before changes are made to policy or mortgage policy, we'd love to be consulted before the policy is changed and provide the insights that we as professionals would love to impart to you. Thank you.
Thank you very much, Mr. Sani and Mr. Hamill and Ms. McKinney for coming. With the Association de Professionnels de la Construction de la Habitation de Québec, not very good French, Mr. Vincent and Mr. Lambert.
Bonjour.
Good afternoon. Thank you very much. Let me introduce myself. My name is François Vincent. I'm Director for Policy for the Association des Professionnels de la Construction et de l'Habitation du Québec. I'm accompanied by Georges Lambert, who is our senior economist. We founded our association in 1961, and we represent 17,000 SMEs that are involved in residential construction and renovation in Quebec. We thank you for the opportunity you have given us today to share with you our opinion by appearing before the Standing Committee on Finance. For our association, we must bank on the real estate market and home ownership. I will invite my colleague to give you an overview of the situation, which is outlined in detail in the more detailed brief we've provided to you. Indeed, Mr. Chairman, the housing sector, that includes new builds, residential renovation, repairs and maintenance, is an important sector. In 2015, the economic value of this sector in Canada was more than $133 billion, so close to 7% of GDP. In Quebec, we're talking about $26 billion, close to 8% of GDP. Our sector creates a lot of quality jobs. For example, in 2013, construction and renovation work contributed more than 172,000 full-time jobs in 2013. This is for Quebec. The federal government also benefits from tax revenue. A $270,000 house sold in Quebec provides $16,300 in tax and tax-related revenue during construction and at the time of sale. A renovation contract of $35,000 generates close to $2,800 to the federal government in tax revenue. With regard to the real estate market, despite relative stability over the last few years, new builds are in decline. In Quebec, the year 2016 saw close to 39,000 housing starts, an increase of 2.7% compared to 2015. Over the past 4 years, housing starts stabilized around 38,000 in Quebec per year. But if we look at a longer period, even if these numbers are encouraging, compared with 2004, rather than in 2016, every year we build close to 1,800 fewer units in Quebec. The slowdown is explained by a reduction in the number of new households in Quebec. However, there are several other factors that we will now deal with. However, what you must understand, and this is our message to you here, the benefits of home ownership. Ownership allows households to build up personal equity. Owner households have a higher net value compared with those of renters. And once people retire, those households that own their home have greater advantages, representing benefits of up to 10 or 15% of their income. However, in Quebec, the situation is such that Quebec has a smaller percentage of owners. In Quebec, 61% of households are owners, compared with close to 69%, 70% for all of Canada. So the question we ask today is, how can we help families access ownership? We must reduce the main obstacle to down payments. It's an obstacle for 7 young people out of 10, based on the poll that we carried out. The same poll also indicates that young people need about 8 years to save up enough money for a down payment. The Government of Canada decided over the last few years to protect the financial market, taxpayers and households, by tightening up access criterion for mortgage insurance. As you know, since 2008, there have been 9 announcements imposing restrictions to borrowers and mortgage insurers in order to tighten up access to mortgage insurance. The most recent measure, announced on October 3rd, will have a major impact in Quebec. Access to ownership will be more difficult for 74,000 households. Housing starts might drop off by close to 7,000 in 2017, and resale of house revenues will be reduced by 7%. These decisions had a major impact on Quebec, which already is lagging behind other provinces in this area of home ownership. I will now call upon my colleague. We would now like to draw to your attention the 4 proposals that we outline in our brief. 4 proposals that might allow the government to reach its objectives with regard to the integrity, protecting the integrity of the financial market, protecting households from high indebtedness, and to contain the housing bubble or prevent overheating of the market, while providing the citizens an important key to have access to home ownership. And we do believe or hope that the committee will be able to follow up on this by making recommendations to the party that holds power at present, to the government, and convince the finance minister to include this in the upcoming budget. First of all, we're proposing that parents might be able to use the funds contained in their RSPs to help their children purchase their first home with a mortgage payment. These funds would be reimbursed for the parents in accordance with the same HBP applicable conditions. A lot of parents want to help their children buy a house, but they don't necessarily have dozens of or tens of thousands of dollars in their account. But with this measure, they would be able to help their children buy a home. These additional amounts of money might also increase what must be borrowed, which would reduce the risk for lenders, and we would see higher down payments that would more easily reach 20% of the value of the house in order that borrowers not require mortgage insurance. Thanks to this measure that wouldn't cost anything to the Government of Canada, we would allow real estate markets in the regions that aren't affected by overheating, in other words, outside of Vancouver and Toronto, to not be subject to the recent effects of the tightening of mortgage rules. And I come back to the criteria mentioned by my colleague just a minute ago. Secondly, we would like to recommend...
Mr. Vincent, could you just lay out your 4 points without the explanations, because we in about a minute and a half are going to have to go to vote. So just name your 3 other points. We have the brief.
Secondly, we are proposing that the government implement down payment assistance grants to help first-time home buyers. Thirdly, we recommend granting a more generous GST new housing rebate for first-time buyers. And fourthly, that there be an increase of the federal first-time home buyers tax credit. And we would be pleased to answer all your questions with regard to these recommendations.
Thank you very much, and I also thank you as well. I know you and I believe one other group had to work to reduce your original briefs to make our word count meet our word count criteria. So we thank you for that. So we will suspend, and we'll hear from the other 2 witnesses as soon as we reconvene after votes. Reconvene.
Nous allons reprendre la séance.
Okay, just to explain to members where things are at, there will be another vote at 5:45. We will tighten up the questions to the current witnesses and try and finish at 5:30, and then that'll give people time to grab a bit of a snack here, go to vote, and come back and start with the second series of witnesses. So that's how we will do it. Turning then to DCL, Canadian Mortgage Experts, Mr. Lloyd.
Thank you. Thank you, Mr. Chairman. Thank you, committee, and thank you, fellow witnesses. I'm a practicing mortgage broker since 1999 in the Vancouver area. I have a lending background going back to 1988. Our company serves both BC and Alberta. We have 130 mortgage brokers on our team, and we did 3,800 mortgages last year for a total of $1.36 billion. Of the changes enacted on October 3rd by the Minister of Finance, the one that impacted Canadians the most severely was bringing consistency to mortgage insurance rules by standardizing eligibility criteria for high and low ratio insured mortgages, including a mortgage rate stress test. From page 36, the Liberal Party of Canada's platform piece states, government should base its policies on facts, not make up facts to suit preferred policy. Common sense, good policy, and evidence about what works should guide the decisions that government makes. The government did nothing to find out from those within the industry the long-term effects of these changes. By making the changes, they have impacted a large number of Canadians, not just first-time buyers, but those already in their homes. By rushing these changes through without researching their impact, we have damaged the competitive nature of the industry and skewed it in favor of one group over others. This will result in more expensive lending for all Canadians. As an example of this, the X family, they live in North Vancouver, and their mortgage of $250,000 is now coming up for renewal. Since
I'll ask you to just slow down a smidgen if you could. The interpreters are trying to keep up.
Thank you. Since their home is now assessed over $1 million, they are now considered uninsurable and must pay a higher rate on their new mortgage term. Another example is Mr. A, who separated from his wife and has been working out a separation agreement since last spring. He has planned to buy her out of the matrimonial home in Kootenays, but no longer qualifies, and now the home must be sold. We, of course, have had a number of first-time buyers who have tried to save the down payment needed to enter the market and buy their first home. Many of those reduced their expectations of buying a house and are instead focused on townhouses and condos. With payments forced to be over 25 years, their buying power is further diminished. Our housing industry in Canada is sound. We survived the meltdown of 2007. We have had a positive impact on the economy. CMHC is a moneymaker for the government and is safer than ever. These changes were not needed and will only cause harm to the majority of Canadians. I recommend the following changes be made to the criteria for insured and non-insured mortgages, allowing 30-year amortizations, stop attempting to restrict investment in rental properties, and remove the limit on insurable mortgage size, which is currently $1 million. I want your questions.
Thank you very much, Mr. Lloyd. And turning to the Mortgage Professionals Canada, Mr. Taylor.
Hypothécaire du Canada, Monsieur Taylor. Merci, Monsieur le Président. Merci de me permettre de vous présenter notre mémoire. Je m'appelle Paul Taylor, je suis PDG.
Thank you. Paul, please. Thank you.
Un micro plus près.
Yeah.
Mortgage Professionals Canada is Canada's mortgage industry association, representing 11,500 individuals and over 1,000 companies. We include mortgage brokers, mortgage lenders, mortgage insurers, and service industry providers. The mortgage broker channel we represent originates 33% of all mortgages in Canada and over 50% of mortgages for first-time home buyers, which equates to approximately $80 billion worth of economic activity annually. Canadians are also increasingly choosing mortgage brokers to obtain a mortgage. Our most recent data shows that year-over-year, mortgage brokers have been used 9.6% more this year than last. Not all of the traditional banks' products are available through the mortgage broker channel, which is an important distinction to make. And the recent changes are having a cumulative negative impact on the mortgage marketplace and ultimately on the Canadian consumer. In light of these, we're asking for some slight amendments to portfolio insurance, which I will get to shortly. As the committee is probably very well aware, as of November 30th, all mortgages submitted for inclusion in portfolio insurance are now subject to the same stress test as high-ratio insured mortgages, and many important categories have also been made ineligible. These changes disproportionately impact non-traditional bank lenders who rely upon the portfolio insurance mechanism for liquidity and ease of access to capital. And as an example of the impact of these changes, Genworth Canada estimated in October 2016 that if submitted today, approximately one-third of their total volume of mortgage insurance written would no longer be eligible. Banks can take loans onto their balance sheets. Smaller lenders do not have the same capital volumes to effectively compete. So as a result, all ineligible portfolio insurance mortgage products now have to be financed by the smaller lenders through other private capital mechanisms, which makes their products more costly for consumers and therefore uncompetitive. From a policy perspective, if the intent of the stress test is to protect highly leveraged buyers from themselves, then all consumers should be subject to the stress test to ensure a fair marketplace. OSFI could achieve this by amending the required underwriting guidelines. Also, setting the stress test at the Bank of Canada's current 5-year rate serves to imply that the government's intention was to favour the big banks over smaller lenders. The rate is set by the mode of the big 5 banks' posted rates, which in effect allows the banks to control the rate that creates their competitive advantage. An important contextual note: while many of the non-traditional bank lenders do not fall within OSFI's regulatory purview, it would be incorrect to suggest they are not regulated. Each province has its own regulations related to mortgage lending, and non-traditional bank lenders statistically originate mortgage loans with equivalent or slightly better default rates than banks. For Canadian mortgage consumers, non-traditional bank lenders play an invaluable and necessary role in a competitive marketplace. There are some significant negative impacts on price of these changes. As of January 1st, the average cost for a conventional mortgage fund is increased by 25 basis points, but in real dollars, that's about $2,300 over a 5-year term. Through the full amortization period of the mortgage, it's about $10,400. In addition to these additional costs, mortgage insurers are increasing their insurance premiums on non-conventional mortgages for the third time in 3 years. This is due to OSFI's newly released capital adequacy guidelines. The premiums in some loan-to-value categories are jumping by more than a whole percentage point of the value of the mortgage. And these, of course, will be costs passed on to the ultimate consumer. The stress test also creates a reduction in the purchasing power for many Canadians, which some of the other panelists here sort of discussed. We have some regional issues as well actually created by those. And many of these will be first-time buyers. Our chief economist, Will Dunning, tells us the stress test will mean home buyers will have a calculated gross and total debt servicing ratios increased by 5 to 7.5 percentage points, which is going to have a material impact on their purchasing power without really changing any of the specific details. The spin-off impacts of a reduction in purchasing power for the middle class could have the unintended consequence of actually creating the scenario that these policies, I think, were aimed to prevent, which is a national debt crisis caused by a significant economic decline. The new capital requirements from OSFI also require insurers to look at 2 new characteristics of a loan to determine how much capital they need to hold on hand to portfolio insure it: credit scoring and geography. We're concerned that these changes create regional price and access disparities that will disproportionately impact middle-class Canadians in areas deemed high risk. The proposal to introduce risk-sharing in the market will also cause major price and access disparities. While Canada has employed historically low default rates, somewhere below 1/3 of 1%, I think it was 0.28% currently on Monday, data has always demonstrated that job losses are the #1 trigger for mortgage defaults. So under a risk-sharing structure, as regional economies suffer downturns, then local mortgage costs are going to proportionately increase. And we would suggest this is the exact opposite result that the government would like to see and oppose the social mechanism that CMHC and the securitization program is intended to create. So, in conclusion, the changes announced negatively affect the mortgage broker channel as a whole, and Canadian consumers have been more and more inclined to use the services of a broker to provide choice, advocacy, and support, and to assist in the technical requirements of mortgage qualification. Placing competitive disadvantages then for the non-traditional bank lenders will adversely affect this segment of the Canadian mortgage marketplace, which consumers clearly are voting for with their purchasing habits. We have 5 recommendations we would like the committee to consider to help mitigate the effects of these changes. First, suspend all regulatory measures not yet implemented. 2. Adjust the November 30th change to allow for refinance mortgages to be included again in portfolio insurance. If an 80% loan-to-value ratio is unacceptable, please consider the threshold to 75% rather than removing eligibility of these products entirely. 3. That the government reconsider the increased capital reserve requirements implemented in January for insured mortgages. 4. We would recommend a review be conducted into the long-term impact of regional-based pricing on the Canadian economy as a whole, and the potential additional harmful effects on already strained regional economies. And finally, please uncouple the stress test rate from the Big 5 banks' posted rates. Use an independent mechanism to determine the rate and require its use to qualify all mortgages, not just those insured. Thank you very much.
Thank you very much, Mr. Taylor, and thank you to all the witnesses. We will go to questions. I think we'll have ample time to get pretty well everyone on. I believe is there a motion to come forward here?
Chair, I'd like to make a motion that Jennifer O'Connell replace Stephen McKinnon as a member of the Subcommittee on Agenda and Procedure of the Finance Committee.
Okay, it's been so moved. As everyone knows, Mr. McKinnon became a parliamentary secretary, vacated his post here as a result. So the motion is that Jennifer O'Connell replace Stephen McKinnon. All those in favour? Opposed? Carried. Welcome, Jen. Turning to... you better not hear McKinnon say that. Turning to first round of questions, Mr. Sabero, 7 minutes.
Thank you, Chair, and welcome everyone. Excuse the delay because of the vote. Seems to happen here once we start session.
Dès qu'on commence la session, il me semble qu'il y a beaucoup de votes à la Chambre.
Quite a bit of time reading all the material related to the housing market in Canada. It's a daily topic for my constituents. We get emails on the latest email I received was for an individual who wanted to buy a house in Waterloo for his daughter. And
par exemple, quelqu'un de ma circonscription qui voulait acheter
and it went for $500,000. Closer to home, when I see houses selling in our subdivision for $1.4, $1.5 million, I kind of scratch my head. And those houses were originally listed in 2007 for about $480,000. So there is something going on, and whether it's a supply or demand side that we need to look at. When I look at all the changes that have taken place within the Canadian housing market, price increases, the flow of demographic side, the flow of immigrants and newcomers and Canadian citizens moving to the GTA, for example, the area that I reside in. There are a lot of natural outcomes, and one of the outcomes has been a very large increase in indebtedness of individuals. And it behooves any government, including my colleagues on the other side, when they were in power, to make sure that changes are made to ensure the system does not go off kilter, that we do not experience something to akin of what happened in the United States. And in Canada, we have a very unique system where the government backstops a large portion of the market, i.e. the high ratio portion, or what's called less than 20% down payment. And going through all the changes that have been made, some of them are quite prudent. There's was a structure in place in the housing market
modifications sont survenues dans les marchés, il y a eu des changements générationnels. Je dirais qu'un bon nombre de changements sont très prudents. En fait, il faut inclure les écarts régionaux. Mais voilà donc ma question.
And this is coming from the Bank of Canada's FSR report in December.
Il y a eu le rapport de la Banque du Canada sur les FSR, vu l'augmentation des niveaux d'endettement.
And I can turn to page 5 of the report. I think it's page 7.
À la page 5 et à la page 7 du rapport.
Sorry, page 5 of the report. The proportion of borders with high mortgage debt is increasing in many cities. Looking in the trends, isn't it prudent for any government when CMHC is effectively backstopped by the taxpayers of Canada
qui est appuyé
to
par
implement
le
measures
contribuable du
designed
Canada,
to
met en œuvre
improve the quality
pour
of
améliorer la
indebtedness for
qualité
borrowers going forward?
de l'endettement à
So
partir
I'll
d'aujourd'hui.
put that out there
Donc
because I think it
voilà
is
une
prudent
chose
for any
que je
government,
propose,
be
je
it
pense qu'il est
on
prudent
the
pour tout
liberal side
gouvernement, qu'il soit
or in the
libéral
past on the conservative side.
qu'il ait été
So if you can take
conservateur,
30 seconds each
d'agir.
to answer that, please.
Et
I'd like to
vous
start
avez
with that.
30 secondes pour répondre à tout cela.
I keep hearing about this income to debt ratio. For me, that is a red herring. There are two types of debt in this country. There's good debt and there's bad debt.
Il y a de la bonne dette et de la mauvaise dette.
First off, who knows how that ratio is calculated? I was in a meeting with CMHC General Manager for Atlantic Canada last week. I asked her that question. Frankly, she could not answer it. Her economist took a stab at it. We're still not sure in Atlantic Canada how that ratio is come to. But it's important to recognize there are two types of debt, good debt and bad debt. A housing payment is a good debt. As it is a debt for an asset that not only appreciates in value, but as you pay down that debt, it creates equity, which is tangible. And it provides shelter, and it builds net worth, and when there is a principle of balance reduction. There are multiple factors put in, considered when granting mortgage financing, debt ratio, income to assets, debt to assets, credit repayment history, credit utilization, income stability, income source, down payment, location, property type, and other qualifying criteria, i.e. the 3% rule on revolving credit. And that is a good debt. It goes through a number of checks and balances to ensure that it is properly administered and that it is on an asset.
Sir, thank you. Can we move on to the next folks? I'd like to hear
respectfully, and there is bad debt. Because I want to get onto this. This is an important fact
Sir,
that you guys are
if we
missing.
can move on to Mr. Lambert and Mr. Vincent.
Mais je voudrais entendre Monsieur Vander et les autres, Monsieur.
Sure, it is good for a government to protect citizens on indebtedness, but in our point of view, the decision that the government made was not the best to help them to have the best asset that they can have with a home, to buy a home. And you talk about that you saw houses in your place that are sold for 1.4 million, but we don't see that often in Trois-Rivières, in Saguenay, in Laval, even in Montreal. If you go in Westmount or Outremont, in some markets where some houses are in that price market, but for a normal house sold in Quebec, and I think my colleague asked the amount, it's really far from 1.4 million. And I think government could act to help citizens with that problem, but not with policy cut the possibility to 74,000 households to have the possibility to buy their first home.
Mr. Vasseur, excusez-moi. I do respect the regional differences in the housing market.
Oui, je respecte
Very well aware with that,
les
and I agree when you don't
entre
want
les
to treat a problem with a
différents
sledgehammer.
marchés et je me rends compte qu'on ne
When-
veut pas
Did not
tuer
say
un
that
coup avec
you-
un
No, no, but I just wanted to add that comment.
Can we get every each of the witnesses on the record in this question because we're up to your time? Mr. Lloyd and Mr. Taylor.
Thank you. Of course, indebtedness is important, and we have to review what it is. But a big makeup of that ratio is not mortgage debt; it's credit card debt and car loans, and those are areas we're probably not going to get into here. But I mean, right now the requirements for our clients to get approved are strict, and then we have to go through and we have to verify a lot of things. And unfortunately, car loans aren't the same, and credit cards aren't the same. And unfortunately, most Canadians, that's where they're running into trouble. And to me, there is good debt and bad debt, and buying a home is something that's going to, even if it doesn't go up, you're slowly going to pay down the debt. The likelihood of it going down in value is slim, whereas those other things aren't adding any assets to their bottom line.
Mr. Taylor?
D'une propriété baisse est beaucoup plus faible que celle que l'autre endettement. Mais en fait, 73% de l'endettement est de la dette hypothécaire. Cela doit être changé. Mais la dette hypothécaire est presque un régime d'épargne sous contrainte et c'est donc bon pour l'économie d'une certaine façon. Ce que j'ajouterais, si vous permettez, on a parlé de la protection qu'offrent les diverses garanties, mais nous avons d'excellentes garanties et les faillites doivent se produire avant que les contribuables aient à payer. Donc, ce sont des choses très importantes à prendre en considération.
Thank you all. Turning to Mr. Leipert.
Thank you all for being here. I'm just going to make a couple of comments and then ask, because there's 4 witnesses, everyone just to make a sort of a general response to it. I come from Calgary, and as you're well aware, the economy in Alberta has not been good for the last couple of years now and probably getting worse. But in speaking with a home builder quite recently, all through the downturn in oil prices, they were still building and selling homes, and he said as a result of the move last fall, the new home construction in Calgary has effectively dried up. So I'd just like you to comment on that. Secondly, I would like you to comment on expand a little bit on the one-size-fits-all approach, because again, you mentioned Quebec. I'm from Alberta. It seems as though Canadians across the country are being penalized because of 2 hot markets, one in Vancouver and one in Toronto. And I'd like you to comment on that. And I guess the third thing is, we had a group of witnesses here the other day, and to an individual, they swore on a Bible that they had not had any contact with federal officials asking for advice on what the right approach is. I'd like you to comment whether that is applicable to each one of you. I'll leave that, all of those with you.
Mr. Taylor first.
Monsieur Taylor d'abord.
We confirm that Mortgage Professionals Canada was not consulted with.
Nous n'avons pas été consultés avant que ces changements soient présentés.
Okay.
Regarding the question of regionality and housing starts,
de régionalité des mises en chantier à Calgary, d'après les prêteurs dans notre collectivité, les demandes de nouvelles hypothèques ce janvier, par rapport à janvier dernier, il y a chute considérable. Les acheteurs d'une première maison sont vraiment pénalisés, donc il n'y a pas de nouveaux entrants dans le marché. Dans les régions qui ont des difficultés économiques, on va voir les effets.
Mr. Lloyd.
D'abord, Monsieur Lloyd.
Yeah, I echo. I wasn't.
Oui, je suis
nobody I know asked anything about these changes.
On ne nous a posé aucune question au sujet de ces changements.
As far as the regional differences, it's huge, and we're trying to solve this Vancouver-Toronto situation with these changes, and it's not effective. In fact, it's not even effective in Vancouver and Toronto. So you're bludgeoning everyone, and it's not fixing anything, and that's the problem I have with this. And I know CMHC's policy has always been not not to always be national, never have a regional policy, but I think those days should change too, and I think we should have more localization for helping different situations, because we all have different situations.
Likewise, to echo the comments of our colleagues here, we were not consulted, although we did raise these issues early November with the staff in the Minister of Finance office. But to pick up very specifically on your point on the effect there, in Quebec, 40% of the buyers, either existing or new houses, are first-time home buyers. The issue here is, yes, it has an impact on housing starts, but as well it has an impact on those, the resale market and the home improvement market. It's all the chain, because those existing buyers willing to sell their house to move in either a condo or a retirement home have a house for sale, either to be purchased by another experienced homeowner or a new homeowner. So it's a chain, and all the parts are linked together. So it affects all it has impact on all the dimensions. And one of the perverse effect of this new policy there, those who are on the brink of buying a house there with just enough down payment saved there, what happened? Oh, we're not qualifying anymore, because you can have, okay, we're going to delay to purchase a house, we're going to purchase a cheaper house or locate somewhere else, we're going to call our aunt or dad or uncle to raise more money, or we're going to stop. No, we remain a tenant, keep that money, and now with that $10,000, $15,000, $20,000 we had saved, we're going to buy a house, a truck, a boat, something, and get some of what was called earlier a bad debt. So you end up in a situation where people will knock at the bank's door, not to borrow for a mortgage, but to get some equity for, or some lending for more consumption, or a trip to the south, a cruise, whatever, some consumption-related indebtedness, which is not backed by an asset that appreciates and that you pay down as a house. So that's the perverse effect, to pick up on what Mr. Soberel was raising earlier. So, thank you.
Mr. Sonny.
Yeah, as far as the Canadian Mortgage Brokers Association is concerned, we were not consulted on any changes, and as I'd mentioned in my opening preamble, we'd like to be consulted. As far as regional policy, I'm going to date myself a bit here, but I was a mortgage broker, started as a mortgage broker in 1988, and there was actually a bisected policy. In those days, there was a $125,000 rule and a $175,000 rule. So if you were in an outlying area, it actually was the opposite effect. You could put a minimum down payment to a maximum of $125,000, and in a larger regional, a larger city center, you could go up to $175,000. So it has worked in the past. When some of these changes came about, our association sent a letter to the Minister of Finance's office with some recommendations, and it's in our submission. And one of the basic ideas here was, how much is enough? How much is a lot of debt? We always talk about a lot of debt. We recommended that maybe we should look at a number, and below, say, $500,000, we could actually qualify mortgages on a discounted rate, because now you have to go to the benchmark rate. And it has affected regions. We are taking issues that are maybe of concern in our primary centers like Toronto and Vancouver, and putting these policies across the country, and it's not really that fair. So this idea of regional policies can work and has worked in the past.
Thank you. Turning to Mr. Caron.
Thank you very much. Thank you to the witnesses. A question I asked the last time, following upon a series of similar questions to those of Mr. Leipert, is, are you generally consulted before changes come into play with regard to the mortgage rules of the federal government? There have been 10 changes approximately since 2006. Is it normal that you be consulted or not? Very quickly, Mr. Taylor.
De répondre en anglais. Mon association, j'y suis depuis à peine depuis une douzaine de mois, mais je sais que lorsque pour le paiement initial on a modifié les règles à propos des questions domicile d'1 million de dollars, il y a eu consultation. Je n'ai pas été consulté moi-même, je sais qu'il y a eu certains consultants.
Mais ça arrive, hein?
Not systematically. Does it happen? No, not really.
No, Simba has never been consulted.
Donc, quelques-uns d'entre vous l'aident de temps en temps.
So some of you are consulted once in a while, but there's no systematic consultation. It can happen, but there's no specific rule. So for PCHQ, I'm sensitive to your recommendations, especially with regard to the use of RSPs. I do have a concern, however, and I would like you to answer because I think it's important. Your proposal is interesting and deserves to be studied, but we have to remove the weaknesses that I perceive in this. Have you estimated the cost for the government of these measures, the HBP and RSP? Mechanically, first off, there wouldn't be a cost for the government because the tax deduction, when the funds are saved and deposited in an RSP, well, the tax measure, the tax deduction applies right away. But to withdraw the funds for home ownership purposes, there is no cost for the government. In the contrary, there's a cost for the taxpayer if the money isn't reimbursed at the right time based on the reimbursement schedule. What we're proposing is that the amounts already available, for which deductions have already been granted to parents who have money saved in an RSP, well, that the children have access to these monies and that they reimburse the money in the parents' RSP based on the applicable standards for ownership. I understand what you're saying. That's theoretical because in practice, transfers between spouses already exist. So a spouse can give the necessary monies to be invested in the RSP of the other spouse. Therefore, it was brought to my attention, in fact, that this measure is used to ensure that there is another purchase of a first home on the part of the spouse who already has a house thanks to the other spouse. So they have a first home, a main residence, but in more comfortable households, let's say, one spouse gives money to the other to purchase a first house. And then, this is done for speculation reasons, and regularly these amounts aren't reimbursed when there's a purchase of another house. And if it's the case, well, it's a tax loophole, and you're opening up the possibility with each one of the children in the same overall family to do the same thing. Were you aware of this technique or loophole? Not specifically. I'm not that aware of the tax law, but two comments. Contributions that aren't reimbursed as they should be over 15 years, 2 years, beginning 2 years after the withdrawal, well, the contribution is added to the income and the tax is payable on the total amount. Secondly, the tax rules with regard to capital gains tax were tightened recently, and it's also very clear that taxpayers will have to declare the sales of properties on their tax return. It's a new condition. And the exemption rules for capital tax gains for residences other than the main residence are already at play. They're already in force. So you have a principal residence and the secondary residence doesn't qualify. There are already rules that limit those opportunities for capital gains. And the government can tax these properties based on the present rules. Clearly, there are always different schemes that can be devised with professionals that can be very creative within the spirit of the laws in force and come up with certain schemes and ideas. But what we're putting on the table is a proposal to help the children access funds that are already there, available to parents. And they've already been accumulated in these accounts. If I might conclude on this, look at any program, any government program or measure. I'm convinced you'll find exceptions. People will find ways to exploit this for the wrong reasons. Think of any other political policy, but you have to think of who might benefit the most from these measures. And it's young people, the 7 out of 10 who don't have the necessary funds to make a down payment and buy a house. But there are measures that might bring about a cost for the government. For example, the GST reimbursement or more generous reimbursement and the federal credit for the first-time homebuyers tax credit, etc. Yes, but there are going to be tax benefits at the point of sale, whether it's an existing property or a new build. There are economic benefits that are present for the government, yes. and the government spends money to stimulate the economy, perhaps it's a way of using these investments and of stimulating ownership. Thank you. I have a final question. It's quite broad, so I would like quick answers from all of you, if possible. I think Mr. Albus and most of us here don't think that there's a single real estate market in Canada. There are several markets that overheat. It seems that the response of the government was to deal with all of the markets at one and the same time. Banks and, by extension, mortgages are under federal jurisdiction. What provinces might be more affected, and what provinces might tackle their own overheating, local overheating problems, do you think? If the federal government reaches the limit of what it can do, what could the provinces do, given that most of these measures are federal in nature?
I think any incentives at all could assist with adding additional supply in the markets that we're seeing these increasing appreciative values in would be incredibly beneficial for everybody. I think almost all of the pricing pressure in the Toronto and Vancouver area is very specifically supply-side issue. I think, to be fair, the government since 2009 has implemented a good number of changes now to tighten mortgage rules, and I would actually argue that many of them were very, very prudent at the time. I think we've got to the point, though, now where we're addressing the entire problem with demand-side solutions when supply is what really needs to be addressed. We're creating real problems for first-time home buyers and making home ownership kind of elitist. We really need to address the supply side.
I agree. I mean, the biggest issues are the supply of homes for people to move into. We can keep hurting the first-time buyers, but that's not going to stop this supply situation.
Clearly, there are very localized problems that are linked to demand. But to resolve the situation in Quebec, based on the reality we face now, well, the solution is to help people accumulate more money in order to not have to resort to insured mortgages, reduce the monthly payments after the purchase.
We talk about supply, and that's important, but it appears that we do have a little bit of a issue in the municipal side of government. They control the land development side. They have the bylaws in place. They have the planning department, and it is very onerous in my discussions with a lot of different people across the country to get a development project started. So what we see, and I'm from Vancouver in the Lower Mainland, you can see after a 7-year delay from the time you actually identify a piece of land that you may want to develop and it actually comes on market. In that 7-year period of time, developers have to carry property. There's a lot of costs. There's soft costs, fronting development cost charges. This is a lot of money that has to be paid for up front. Their interest costs accrue, and then in the end, as I mentioned earlier, it's the home purchaser that actually pays for this. So streamlining that level of government, would it be incentives, some capital expenditures to get water treatment facilities, land dedication in place? These actually delay land development projects, and at the development side, there's costs involved acquiring land. We do those mortgages as mortgage brokers as well for these developers. Those costs accrue. So that's one way of maybe improving the supply side. You have to make it easier. It's very difficult.
Thank you. Mr. Grewal.
And thank you, the witnesses, for coming. There's a lot of theories on what's going on in the Canadian housing market. I just had a few questions on data related, and I'm hoping that you guys can answer this. Can any of you guys tell me how many homes are purchased with less than 20% down payment?
I don't have those numbers handy. I think it's something that could be looked up, but we as brokers see a lot of first-time buyers, and there's no doubt there's an inordinate level of people that are putting a minimum down
rationale
payment.
for the question is this, is that the new stress test will obviously impact people buying a home with less than 20% down. And then you guys are advocating for the fact that, you know, it's going to impact your business.
Ça va avoir un impact sur votre entreprise, sur vos entreprises également, sur votre secteur. We're less concerned about our business than we are about the Canadian consumer and the housing market itself.
Either way, even if we're concerned about that, I think that at the basics, we would need to know how many Canadians are actually purchasing homes. And you guys are in the mortgage business, so I would feel like this is one of the numbers that you would know right off the top of the head. It's like, yeah, X percentage of Canadians are buying homes with less than 20% down.
So I can say that we did a sweep of our home buyers from last year, and I don't know how many are less than 20% down, but on that sweep of our home buyers from last year, close to 20% of them would not have qualified for their mortgage this year that they did qualify for last year. One of our agents who does a lot of relocation for military relocation, close to 15% of her relocating members would not have qualified for the mortgage in the new area that they were forced relocation that they were moving to, given today's economy.
Second question, after the rules were implemented, have you guys seen a decrease in the number of people applying for a mortgage?
Not applying, but certainly qualifying. And if I can go back to your first question, first-time home buyers, at least in Atlantic Canada or in my neck of the woods, which is Halifax, most first-time home buyers are coming in with 5%. It's not, the problem with it is that it's a ripple-up effect. So if that first-time home buyer can't qualify with 5% down, whose home are they buying who may have a 20% plus? If the person who has a 20% plus in equity on their current resident that is selling to that first-time home buyer, how do they then sell that house and move on if we don't have a first-time home buyer qualifying at 5% without a stress test? Stress test eliminates that first-time home buyer in a lot of cases.
Okay, my next question is this, is that, yeah, go ahead, Paul.
To the answer about the data, Canadian Real Estate Association will have
L'Association immobilière du Canada a des données sur toutes les maisons qui ont changé de main. Si on compare ça au dossier CHL, on peut avoir le chiffre assez rapidement, savoir combien de ces achats se sont faits avec moins de 20%.
Just so you know that in our industry, we're not able to collate all that data because it does go, it funnels through to the insurers, and that's where that data is held. We're just not going to be privy to that.
But you guys are also part of the industry.
We're part of the industry, but we have
my next
access
question
to data.
is actually, how are you guys compensating individual mortgage representatives? So if I'm a mobile mortgage specialist in a city of Brampton, let's say, in my neck of the woods, how do you guys, what's the compensation model based on that?
First thing I want to point out is there's a big difference between a mortgage broker and a mobile mortgage specialist.
Okay,
Huge difference.
I know the difference.
Well,
my question,
then you should ask about the mortgage broker respectfully, sir. Because a mortgage
with all due respect, sir, you didn't even bother listening to my question. My question was this, is that how do you guys compensate mobile mortgage specialists, or people that their business is to go get clients who purchase homes and get their mortgages approved?
We don't compensate mortgage mobile specialists because we are not them and we don't utilize them.
Okay,
we are mortgage brokers. There is a difference. You need to understand.
Okay, thank you, Mr. Hamilton.
Sir?
Yes, go ahead.
Monsieur, allez-y.
Necessarily between an individual who's an employee of a financial institution.
Il y a des gens qui sont employés d'institutions financières et qui vont chercher des prêteurs d'argent. Il y en a comme les courtiers qui représentent plusieurs prêteurs.
To answer your question about the percentage or proportion of those purchasers who use 20% or less down payment, we ran a survey last year, about a year ago, for all the Quebec market, and we have an estimate of something of 68 of all purchases would be with 20% or less of a down payment. That does not amount necessarily to use of mortgage insurance, but we're talking about those who answer the survey with how much down payment did you put there.
Thank you so much, George. So my question would be this, that 68% that bought homes with less than 20% down payment, they were subject to a stress test before our rules were implemented. Is that correct?
In those statistics here, to be more precise, relate to a past 5 year period. So I cannot speak to which rules were in effect at what time there, and you're right, stress tests and other rules were put there, but one of the most popular terms for mortgage, and our colleagues here will correct me, is the 5-year fixed term is one. 67% of the borrowers use a 5-year fixed mortgage. So that's the novelty here with relating to the last October announcement.
The very key distinction actually between the current
Il y a
and the
une
previous
distinction à faire entre le test aujourd'hui. Là, on parle de gens qui ont une hypothèque pour moins de 5 ans. Avec une hypothèque à taux fixe, vous ne payez pas à l'équité. Même avec 5 %, après 5 ans, vous avez atteint 20 %. Maintenant, avec la nouvelle règle, les critères d'admissibilité ne sont pas les mêmes.
Stress test. The stress test for mortgages has always been there. That's the underwriting qualification criteria. It was maybe enhanced, but this idea that it's something new, it's not new. We've always had criteria for qualification. It was just actually made it a little bit more difficult or stringent. So these checks and balances have been in place for quite some time.
Raj, do you have one quick wrap-up question?
Yeah, like what we heard from testimony is that the government is overreaching, that we're over-regulating, and that the impact is going to slow down the housing market, and it's going to have a negative impact on first-time buyers. Is there any actual research, or are you guys all of the opinion that it's too early to tell?
Ou croyez-vous qu'il est trop tôt pour se prononcer? Ce n'est pas trop tôt pour se prononcer. Notre association représente beaucoup de prêteurs et d'assureurs hypothécaires et ils vont nous dire qu'il y a eu une baisse du nombre de demandes pour ce genre de prêts hypothécaires et une baisse des assurances hypothécaires. Et il y a des témoins qui pourront vous donner des données beaucoup plus pertinentes à cet égard. Depuis 2 mois, il y a un ralentissement chez nous, en tout cas. Une baisse de 30%.
Drawing from the 2012 announcement to shorten the amortization period from 30 years to 25 years, 20%, 21% housing start reduction in Quebec, 6% or 8% decrease in resale, and the impact of that shortening at the result of pricing out 39,000 households in Quebec who were not necessarily looking to buy, but had they wanted to buy, could not buy a house at average price then, given the change in the income requirement to purchase an average price rate.
Okay, just hang on. Has everyone answered your last question? Okay, quickly.
Saying that is the market slowing down? Well, yes, it's going to slow down, but it's going to also, it's a bit early to say, but it's going to slow down, obviously, the first-time buyers, the people who are on the fringes. But one compounding effect that we may see coming forward is that a first-time home buyer, what were they before? They were most likely a renter. And we have a limited rental pool in many centers. Now, the problem is that if you keep people in the rental pool and you can't get people to qualify as first-time buyers, you're going to have another stress test, in a sense, or difficulty for people who want to rent. And those rents could possibly go up. So the overall cost is not just to the home purchaser, but to the actual person who's looking to rent. In Vancouver, the vacancy rate is very low. If we don't remove people from the rental pool and make them first-time buyers, then we have an issue of housing again on the rental side.
Okay, I'm going to stop you there, sir. We'll go to Mr. Detel.
Thank you, Chair. Ladies, gentlemen, you're welcome in your House of Commons. Very pleased to see you all. But I can say that I'm very proud that what we have heard a few minutes ago. It's totally unacceptable and unbelievable that this government took such a great, important decision without consulting any one of you. And you're not the first. We have heard some other witness before who said exactly the same thing. This is totally unacceptable, but at least, thanks to this committee, you can express yourself now. Alors, ma question va porter évidemment pour Messieurs Lambert.
So my question is for Mr. Lambert and Vincent. Thank you very much for being here with us. You underscored several elements that really surprised me. With regard to the fact that you're expecting a drop of 7% of the sales on the market and 40% of your customers are first home buyers, which means that there's a lot of pressure on the policy brutally announced by the government. I said brutally because there was no prior consultation. However, what's good in your case is that you offered solutions to have intergenerational RSPs to allow parents, without wanting to age myself more, but I'm proud of having 2 children in their 20s and who are starting out in life. And your proposal for intergenerational RSPs are a good idea. I could use mine as a lever for my children to purchase their first home. But also the idea of improving the tax credit for first home buyers. And there's also the HBP. I don't have much time, so forgive me for talking quickly. I have another meeting waiting for me, but I would like you to explain further to us your 4 proposals. You explained the intergenerational RSP, but what about the 3 others? And did you cost these proposals? Have you assessed what the cost might be for first home buyers if we follow through with your recommendations? We have 3 other options. With regard to the GST reimbursements that already exist, that allow the reimbursement for new houses based on the price of the house up to $350,000 before taxes, and the reimbursement of GST available, that reimbursement was introduced when the GST was put into force to neutralize the effect of the GST on the purchase of a home, which is an important purchase, and to allow for affordability. What we're proposing is to make this reimbursement more generous for first home buyers in Quebec and for new builds. About 38,000 housing starts were there for new houses, and 40% of them would be for first home buyers. So we're talking about some 15,000. That would be multiplied by help, assistance, amounting to several $1,000s more. We'd have to quantify this further. We haven't detailed the impact. That's up to the government, the Minister of Finance, and the officials to determine the latitude that there might be to set the parameters. But the idea is to add an incentive that would be more generous to help with the down payment upon purchase. That's for the GST reimbursement, the rebate. And for the tax credit, it's quite simple. The maximum amount is $750, and when you purchase a house, there are all sorts of other costs that come into play at the same time. And we said that one way for the federal government to help at that time would be to increase the tax credit and make it more substantial to respond to that situation. And the amount that we're proposing, that, well, it could go to $3,000, $4,000, maybe even $5,000. The idea is really to help individuals who need help most. And the second measure in our brief for the down payment, it could be an amount that already corresponds to the amount accumulated by a household. Let's say they already have $10,000, $12,000, $15,000 set aside. The government could lend that money, come into the transaction with the same amount of money, and the household that would benefit from this assistance would, let's say, have 7 years to reimburse the money. So it would be a minimal cost for the government. We set out parameters that gave examples, but we didn't cost it out fully because if the measures put in place and purchasers, buyers are interested, their behavior could change, and that might change people's preferences. So we have to take into account reactions. So it's very risky to set out what this might represent cost-wise. With regard to the down payment, I hosted discussions about this. BC has just announced that it gives assistance for down payments on the purchase of a first home. It can amount to 5% of a house, $3,700. In Montreal, it's 5% for the purchase of a condominium, under the SHDM, and the reimbursement is made when the house is sold or remortgaged. And Quebec City put in place a similar program. So it could represent an investment for the government, but it would be reimbursed. So long term, it could be interesting.
Okay, thank you. I'm going to move to Mr. Fergus, but I just want to say that in about 2 minutes, the bells are going to start. I'll have to interject and get unanimous consent to continue on. So you have 5 minutes, sir.
Thank you, Mr. Liepert. Thank you all for coming here. I'm glad that you have an opportunity to present not just a snapshot of what's happening, but giving a full story. And just considering the last question, I did appreciate that you had an opportunity to respond to Mr. Caron's very good questions about whether or not this was sort of traditional in terms of the level of consultation of your specific industries or your specific companies by the government. I'm really interested, Mr. Taylor, if I could, if you could describe to me, because I'm new to the finance community, so if you could describe to me a bit of a profile in terms of the customers that come to your membership stores. I'm just trying to figure out, do they carry more or less leverage than using more traditional means? I mean, do they have more of a, can you use a loan-to-income metric or if your debt ratio metric? Can you give me a bit of a description of a profile of your average customer, not your best, not your worst?
Client moyen,
thank you very much for the question.
Merci de votre question.
This may take a moment or two, so I
Ça pourrait prendre quelque temps.
We're an association
Nous sommes une association de prêteurs, d'assureurs et de courtiers hypothécaires. Et parmi les prêteurs, il y a TD, il y a la Banque de la Nouvelle-Écosse, toutes sortes d'autres institutions financières. Nous avons des grands prêteurs et aussi de beaucoup plus petits prêteurs. Les compagnies de financement hypothécaire ont moins accès au marché et les grandes compagnies ont plus de moyens à leur
If I could just interject for a moment, I need unanimous consent to continue since the bells are going. Do I have unanimous consent?
Le consentement unanime
Thank you.
pour poursuivre vu que la sonnerie a commencé à retentir. Merci, Monsieur Taylor.
Okay.
Je pense avoir répondu à la question.
If I could please ask.
As a mortgage broker,
courtier hypothécaire.
I was just about to ask Mr. Soni if he would mind giving me a sense of
J'allais demander
similar question. Well, what is our average type of client? Our average type of client is the average Canadian. We see a full spectrum of mortgage applicants. We see the first-time buyer, which is a large portion of a mortgage broker's business, but we also see the full spectrum to the point where we're doing development projects in the multi-millions, 30, 40, 50 million. We provide debt consolidations. We provide construction financing for small builders, average builders. The profile is the profile of a mortgage borrower. We see them all. We see high net worth individuals as well.
Perhaps compared to the banks. If I could just characterize it that way. Would your clientele be more leveraged than the banker's clients? The average.
It's hard to say. I wouldn't say that they're more leveraged. There's certainly going to be some individuals based on our value proposition as mortgage brokers where we're going to deal with some people that could be placed into the higher category or risk area where we're using alternative sources of financing. But we have a lot of clients because, as Paul has said, a lot of our lenders are balance sheet lenders. A lot of our large monoline lenders like First National or MCAP, they're looking for the quality borrower. We, as mortgage brokers, nobody faces a strong, in a sense, stress test on the underwriting guidelines as a mortgage broker. Our files are scrutinized, they're audited, and they're good quality Canadian borrowers.
So you're saying then, perhaps if I could understand this, and again, help me out here, if your profile is the same as the major banks in terms of whether or not your clients are financially stretched, then
que vos clients aient les moyens de s'endetter ou non. Pourquoi avoir une approche différente? Lundi, on nous a parlé des changements et des conséquences que ça pourrait avoir de façon différente sur différents types d'emprunteurs. Il y a des emprunteurs qui ont une cote de crédit moins attrayante, si on peut dire. Et à ce moment-là, le taux d'intérêt de l'hypothèque peut être plus élevé. Ça dépend donc un peu de la catégorie d'emprunteurs. Il n'y a pas vraiment beaucoup de différence entre la clientèle qu'on voudrait obtenir et les autres. Chacun des prêteurs qui utilisent le programme de titrisation a les mêmes mécanismes. La grande différence entre les deux cas, pour ce qui est de la concurrence sur le marché, c'est que parce que les petits prêteurs comptent davantage sur la titrisation, et ça réduit les risques. Ça veut dire que les hypothèques, c'est presque impossible pour des personnes qui entrent dans cette catégorie d'obtenir une hypothèque. Quand vous investissez dans une obligation, à ce moment-là, la part sur le marché est très faible. Si l'hypothèque est assurée,
okay, I have to stop you there, sir. So we'll take 2 more sets of questions of 5-minute-ish each. So we've got Mr. Albus, Mr. O'Connell, and then we'll conclude.
Thank you, Mr. Chair, and thank you again to all of our witnesses here today. I'm becoming very concerned because obviously GDP isn't where we'd like it. We're seeing a lot of the forecast downsize in many different respects. 13% obviously of GDP Canada is related to housing. So this is, I think it's important for Canadians to know when the government adopts a new policy or is looking to adopt new policies as well, that could have severe limitations or implications for them. So, for example, what from the previous October announcement and the implementation of the policy, things have been taken away. Options have been limited to Canadians. So let's start with amortization. Some might just say, well, shouldn't amortizations be at a maximum of 25 years? Mr. Lloyd, you work in Vancouver and the Metro Vancouver region. What do you have to say on 25-year amortizations, 30-year amortizations?
It sounds like a good idea, but the longer amortizations allow people to get into a home, keep that payment lower when they first move in, and then as they move along, they can increase their payments and pay it off faster. Just because it's a 30-year amortization doesn't mean it takes 30 years to pay that mortgage off. As soon as the client adjusts to biweekly accelerated, it knocks almost 4 years off of that right away. So to take away that mechanism, which is it's a simple mechanism, it allows somebody to get into that house faster. I think it's just it doesn't make sense because it allows somebody to do that in a very simple way, and in the long run, it doesn't hurt anybody. They end up paying it off faster, like I said. The majority of my clients never take that long to pay it off, and we encourage them to look for ways to pay extra payments on the mortgage and get it paid down sooner.
A lot of young people, the 30-year mortgage was a good option, but now that's just not there anymore. Particularly, we're living longer, so obviously people are also choosing, in some cases, to work longer. They have longer lifespan cycle to be able to pay for these kinds of things. So to me, it would seem strange that we would be limiting that down and forcing some people to use up rental stock, which eventually raises prices in that area because supply isn't any better for rentals as it is for new construction. Now, you also mentioned a gentleman in the Kootenays who had a divorce. We're also seeing divorces are higher. And another thing that's been taken away is the ability to refinance. how have the changes impacted Canadians' ability to refinance their homes?
Canadians work hard to pay that mortgage down and to build up that equity. And these changes, what they've done is the vast majority of our lenders now can't do that because they're what we talk about with bulk insuring and selling off their books. They're not allowed to insure a refinance. So client can't do anything except maybe go to a big bank who's going to probably charge the higher rate to do that because it's going to be a smaller and smaller group of people that can do that for them. So it doesn't make any sense to me when a client, a lot of the times refinancing is what we use to invest back into the economy and build businesses and do good things, buy rental properties.
And that's a very good point because a lot of people, what they'll do is they'll build up that equity in their home, then take it out at some point, which now they may be denied, and either put it into starting the business or enhancing their business or perhaps creating new rental properties so that they can sell, or so that they can have that extra money coming in. So what happens if someone wants today to buy a rental property? To be able to use that as another way to bring income for their family.
They have to have 20% down and they have to go through a bank.
Okay. So what was that previous to this policy being implemented?
Previous to that policy, we had access to all the non-bank lenders that had various policies.
Okay. So this is hurting the economy. It's hurting consumers because I hear from them in my riding, and particularly when I talk to people in Vancouver, it's just, it's crazy. It's making it harder for people that, to get good rental housing. Now, obviously, the competitiveness, and Mr. Taylor's really touched upon this as well. So, I'm concerned that because of this, not only will it put many of the monoline lenders at risk, and by the way, that means less competitiveness. What does that mean for the market for Canadians in 10 years? We've heard from other people say, credit unions say, that they have to risk or to add a risk premium to things, and they can't do it because they are not allowed to retain earnings. So, to me, that whole end of the market will shrink. Where will we be in 10 years as far as competitiveness and price?
Well, I can tell you, I started in 1994 as a loans officer at a credit union, and the most we could discount a 5-year rate was 0.25%, and that was for our absolute best client. Since brokers in the monoline industry have come along, we've grown that, and now a normal discount is 2% off of a 5-year rate. It could easily go back the other way when it's back to just the big banks.
Okay, sorry, Dan, that's 5 minutes is up. Jennifer, and then we'll conclude.
Thank you so much, Mr. Chair. Thank you all for coming. In terms of, I heard the conversation around good debt and bad debt, and I get it. However, isn't there the factor that whether you have an individual who perhaps has a mortgage that is a little bit more than they can afford if interest rates to go up, or a person who has a boat and a mortgage and can't pay both, that ultimately, if you can't afford your debt, whether it's good or bad, you stop paying for it, and therefore causes problems within the economy. So this notion that, if you have good debt, that's all fine, and if you can't afford it, well, it's still considered good debt versus someone who can't afford their boat payment. So my question is, if there was concerns about, my colleague just said that this hurts the economy. I'm wondering, what would hurt the economy and the housing market more? Would it be telling an individual that if interest rates were to go up, you could only afford this type of mortgage, or allowing them to have whatever mortgage they prefer without stress testing it to the realities of the economy and the situation right now, and homes and mortgages being defaulted? That is the option. You tell someone you can afford a little bit less, or they bite off more than they can chew in economic situations and mortgages default. How was that experience for the U.S. and people's biggest investment in their homes? Because when defaults happened on mortgages, so did value. So all that equity that was discussed was no longer there. Wouldn't that hurt the housing market dramatically if we didn't prepare and protect the risk like that?
Well, this idea of good debt and bad debt When we lend somebody a mortgage, at that time, they follow the stress test. There's going to always, in other words, they qualify. There's always going to be an element of individuals that, and it's a small element, that will take their mortgage, everything's good, maybe they'll buy a boat after. Well, that's after we'd actually qualify them. That's going to be a small element, right? Your worry is that people take on too much debt. Well, let's look at the great success stories of all Canadians that have bought their first home. Think of your parents, think of your grandparents. There hasn't been an easy, I haven't heard one easy story about the first home people have bought. Sometimes they may feel a bit stressed, but are we to say that the average Canadian is irresponsible with debt? I don't think they are. I've been a mortgage broker since 1988, and I've seen nothing but success stories. Have we had some market slowdowns in that period? Yes, we've had. The vast majority of people continue to do what they have to do to make their mortgage payments. And today, when they first, say 25 years ago, when they were 25 years old, it was tough. Today, they've paid off that home. And they've been able to use that to fund their children's education.
Sir,
I just... time, so I'm going to interject, but I'm glad you actually brought that up, because the comparison between myself to my parents had double-digit interest rates. Double digit. And so that comparison is exactly why we were doing this, to protect for changes in interest rates. So I want to just move on quickly because I have very limited time, but you spoke about municipal fees. This is my wheelhouse. I was a municipal councillor for nearly 10 years. And the suggestion to make development easier is actually the exact opposite argument that you make in terms of regional differences. In my home province of Ontario, the province determines a lot of the supply in the area, and municipalities must comply with that first. So if you took supply issues and made the federal government made a broad approach to that, you would have very different impacts across this country. So it's the exact argument that you are arguing against in the sense of regional differences. And wouldn't it be better to ensure that debt is debt, and that if people are at high risk, then we ensure that there is protection in the market for when interest rates change?
I'm going to have to interject. I know there's a couple of hands up, so if you can answer Ms. O'Connell's question in about 20 or 30 seconds, there's maybe time for a couple of answers, and then we have to conclude.
First point I'd like to make is these changes are a little overreaching in how conservative they are, and the amount of capital that needs to be reserved to ensure that the financial system doesn't fall apart, as you have alluded. Our default rates, actually not even our arrears rates for mortgages, are currently 0.28%. As we heard on Monday, they peaked in Canada at 0.65%, which is by no means anything close to what happened in the U.S. Interest rates dictate the stringency of the credit underwriting used to issue the product. Very, very simplistically. A credit card issued at 20 points can be issued with almost no underwriting. There's an expectation of default. That's what the market risk premium on that is for. At a 2.5% interest rate for a mortgage and the bonds that have been issued, believe me, the underwriting standards in Canada before those loans are issued are second to none in the world.
I have to stop it there. I'm sorry. Can you answer yeah, because we have to go to a vote. For those presenters who are here to present at 5:30, unfortunately, we have 2 votes in the House at 5:45. We cannot reconvene until closer to 6 p.m., so I apologize for that. But we will reconvene as soon as the votes are concluded, probably around 6 o'clock. For the presenters here at the table, thank you very much. We'll see you all back after the votes. We'll resume with the with our witnesses. Obviously, our apologies for delaying you. However, we didn't have much choice. We had to be in the House for 2 votes. In light of that, and because our scheduled time is for 7:30 for adjournment, we've got 4 different presenters, I believe. I would ask each one of you to try and be as concise as you can. And then I would ask all of the committee members to be as concise as you can in your questioning so we can get the most number of answers in. Try and keep it on track. And so who have we got here? We have the First National Financial. Is that Mr. Smith?
Yes.
Please go ahead.
Merci, Monsieur le Président.
Thank you, Mr. Chairman. Thank you for having invited me to appear before you this afternoon. I was born and raised in Ottawa, where my father was a civil servant. It is always a pleasure to return.
That underwrites about $23 billion a year of residential and commercial mortgage loans. In addition to be Canada's largest non-bank mortgage lender with 950 employees across the country, we're also publicly owned and traded on the Toronto Stock Exchange. We use mortgage brokers to distribute our products and CMHC securitization programs to raise the capital to fund these mortgages. We've employed leading-edge technology together with competitive interest rates and a high level of service to achieve our goals. We do not compete on credit quality, and in fact, our credit quality meets or exceeds any lending institution in Canada. We estimate that we have provided about 1 million Canadians with the financing to enable them to achieve their dream of home ownership. One of the cornerstones of our business model has been our relationship with the Canada Mortgage and Housing Corporation. CMHC was founded in 1945 to provide funds for housing for soldiers returning from the war. In 1954, CMHC introduced mortgage default insurance in an effort to provide liquidity to Canadians for home ownership. In addition to CMHC, there are 2 private sector competitors to CMHC who now serve almost 50% of this market. In 1987, CMHC introduced NHA-MBS, and then in 2001, the CMB program, Canada Mortgage Bond. These securitization programs have allowed pension funds, mutual funds, and other non-deposit taking institutions, both domestic and international, to provide mortgage funding to Canadian homeowners. Prior to 1987, it was only the large deposit-taking institutions that could raise the large amounts of capital necessary to fund the mortgage market. Consumers' choice was quite restricted. The outcome has been to create a bigger playing field in Canada, give Canadians more choices in mortgage financing, and ensure robust competition among lenders to provide lower interest rates. CMHC has been an immense boon to Canadians seeking home ownership through its mortgage insurance and securitization programs. The Minister of Finance has worked in tandem with CMHC to control and protect the Canadian housing market. Since 2008, pursuant to the credit crisis, the Minister has introduced a number of changes to moderate consumer debt through mortgage lending. We have supported these changes. In October 2016, the Minister announced more changes which affect the mortgage industry. These changes included increasing the qualifying rate for 5-year mortgages from the mortgage contract rate to the Bank of Canada rate. This change effectively reduces the amount of mortgage a borrower seeking a 5-year or longer term mortgage can borrow. The rationale is to ensure the borrower has the financial resources in the event of rising interest rates at renewal, and at the same time temper some of the demand in the overheated markets. While we are supportive of this change, it must be noted that this change only affects insured mortgages, which is less than 30% of the overall market. The remaining 70% of the market, which is uninsured, is not affected. As the average insured mortgage in Canada is $300,000 and mortgages in excess of $1 million cannot be insured, this change will reduce the affordability of housing for first-time home buyers in the softer markets in the country, Prairies, Quebec, Atlantic Canada, and will have a minimal effect in the overheated markets in Vancouver and Toronto. The most significant and structurally negative change announced in October was the elimination of the availability of mortgage insurance for borrowers who wish to refinance their mortgages. Canadians have always used the equity in their homes to borrow money efficiently to fund home renovations, children's education, and other financial needs. The new rules significantly restrict the options these borrowers have and put the clock back 30 years to 1987, when the only choice for these borrowers was to use the large domestic financial institutions. We view this as a retrogressive step, contrary to the broad public policy goal of promoting competitiveness and certainly contrary to CMHC mandate of helping to house Canadians. Subsequently, OSFI introduced changes to the capital requirements for mortgage insurers. These changes, effective January 1st of this year, require mortgage insurers to hold substantially more, and that's in the area of 2 to 3 times more, capital for a conventional mortgage relative to the capital required to be held by a large domestic financial institution for exactly the same mortgage. These changes, by essentially pricing out of the market those lenders who use mortgage insurance and securitization to fund their mortgages, will have the same negative effect on Canadian homeowners as just discussed. In summary, we would request the Minister and the Superintendent reconsider their decisions to make mortgage finances ineligible for mortgage insurance and to make no further changes to the rules governing the housing sector until the most recent changes have been absorbed by the marketplace and are fully understood. I'd be delighted to take your questions.
Thank you, sir. We'll move on to Canada Guarantee Mortgage Insurance Company. Mr. Charles.
Thank you very much, and good afternoon to the committee members. My name is Andy Charles. I'm the President and CEO of Canada Guarantee Mortgage Insurance Company. By way of introduction, we are Canada's only 100% Canadian-owned private mortgage default insurer, and since 2010, we've helped over 250,000 Canadians enter their homes. Our company insures Canadians, primarily first-time home buyers, who place less than 20% down payment on their house purchase. We take the view that Canada's housing finance system has served our country well, particularly when contrasted to other jurisdictions. Canada has avoided some of the pitfalls other countries have experienced. In part, this is due to conservative underwriting practices in the mortgage industry, strong regulatory oversight, and the avoidance of tax incentives that discourage the reduction of a borrower's mortgage debt. I believe the rest of the world looks at Canada's mortgage insurance structure as a key factor in our overall housing finance stability. Since 2008, Canada Guarantee has supported the various government interventions that moderated the housing market as being both prudent and well considered. While these interventions have primarily targeted first-time home buyers, they have served to strengthen Canada's housing market. However, we do believe the impact of the most recent changes, in combination with the new regulatory capital framework, are potentially detrimental to the housing market. I would like to take a moment to describe today's typical first-time home buyer for the committee. The average first-time home buyer ranges in age from 25 to 40, has average household incomes of 80 to 100,000. The first-time home buyer segment now represents just 30% of annual new mortgage volumes, as compared to 40% in 2010. They have an average mortgage size of $300,000 and an average credit score of 753. This is a score that demonstrates a very high level of credit worthiness. In addition, the insured marketplace has a maximum of $1 million house purchase limit, a ceiling that generally precludes the first-time home buyer from participating in the GTA or GVA markets. The headlines one reads about elevated housing market activity in Toronto or Vancouver is not and has not been driven by the first-time home buyer. I would like to share more specific observations regarding the recent regulatory changes and our perspective for the future. The concept of a uniform, homogeneous national housing market does not exist in Canada. Accordingly, national policy levers can be problematic when the issues are regional or even city-specific. While Vancouver and Toronto have experienced significant property value increases, Calgary, Edmonton, Montreal, and other markets most certainly have not. This requires local or regional solutions to be considered. Recent housing policy decisions taken by the BC government are evidence of a regional solution to a regional issue. While it is important to reflect on the cumulative impact of the regulatory changes over the years on the first-time homebuyers' ability to enter the housing market, we believe the policy changes announced in October 2016 to be the most significant intervention to date. Specifically, the elimination of low-ratio refinance eligibility will reduce choice for borrowers by impacting the competitiveness of Canada's monoline lenders. More borrowers may seek mortgage funding from private lenders, representing a higher cost option and with limited regulatory transparency. The combined implication of the Department of Finance changes of October 2016 followed in short order with the introduction of a new regulatory capital regime will materially change the housing market dynamics in our view. Before further regulatory initiatives are considered, we need to pause to understand the longer-term impacts. And recognizing the potential cumulative impact of these changes, we encourage the government to consider the following recommendations. At this point in time, do not proceed with a risk-sharing model. Study the results of the most recent changes before considering any more. We now anticipate the first-time homebuyer segment share of new originations will drop to just 20% of the marketplace. I would take the view insured first-time homebuyers are the most regulated segment in today's housing market. They are not the problem, and any further targeting of this segment we take the view is counterproductive. Lastly, Canada has indicated plans to welcome 300,000 immigrants to Canada next year, a policy decision that we welcome. The majority of these immigrants will reside in our major markets. We will need to house these new Canadians, and we encourage all levels of government to coordinate their actions to ensure the necessary housing stock exists to accommodate. I thank you for your time.
Thank you. We'll move to the Canadian Home Builders, and is it Mr. Finnegan? Thank you.
Thank you. I am the president of the National Association and a builder-developer from Toronto, and I'm joined by Jason Berghoff from our association staff here in Ottawa. And thanks to the committee for undertaking this study. Simply put, housing matters. It matters to the economy. It matters to our huge industry of small businesses that supports over 1 million workers. It matters to Canadians who recognize homeownership as a cornerstone of attaining the middle class. And it matters that all Canadians have a security of a decent roof over their heads. We know that there are ways to address stability concerns without causing damage to our industry or the economy. We are concerned that measures to cool markets can easily precipitate economic decline, triggering the very conditions they were intended to safeguard against. We are also concerned that these measures move CMHC away from its purpose under the National Housing Act to ensure equal access to mortgage markets for all Canadians. If such measures lock out otherwise qualified homebuyers, they can cause a downward spiral in local economies. We need to be careful. We need to be careful because residential construction has been a major source of stability for Canada's economy in recent years. Today, residential construction supports over 1 million jobs, pays $58 billion in wages, and generates over $128 billion in economic activity, including over $41 billion in government revenue. Home building and renovation is a vital part of every community, large and small, across this country. So effective housing policy is key to supporting Canadians, businesses, and communities in achieving inclusive economic growth. If we are going to support the middle class and those aspiring to join it, we need to ensure that first-time homebuyers and new Canadians have a fair chance to attain that cornerstone of the middle class, and that's home ownership. What's more, the current situation, if not curbed, will lead to a wider and wider gap between those who already have equity stakes and those who do not. We are facing the potential of the homeownership situation creating social inequity within communities, between regions, and between rural and urban centres. To effectively address our housing challenges, we need to understand what's driving the markets. Why are so many Canadians now having a harder time becoming homeowners? Housing affordability is determined by 3 factors. These factors are income, mortgage rules, and house prices. In terms of income, we know that millennials were hardest hit by the economic downturn and ensuing jobless recovery. Their income growth has been muted, yet house prices have escalated dramatically. We need to spur economic activity and income growth in all sectors so that young people can prosper. At the same time, to guard against financial system instability, mortgage rules have been tightening, making it much harder to finance a house. While many of these measures have been intended to cool the markets like Toronto and Vancouver, their application has been national, and that impacts markets like Atlantic Canada that were already in a bad state. Our recommendation on mortgage rules at this time is simply this: do no more. please stop for now. There have been many recent changes, the full effects of which have yet to play out, and it is critical to let these impacts become fully evident before any other actions are taken. There are also mortgage-related tools at the government's disposal that can better be utilized without increasing market instability or leveraging. Increasing limits to the first-time homebuyers plan and allowing intergenerational RRSP transfers within the plan could facilitate increased down payments and decreased homeowner debt. Perhaps the most interesting options are shared appreciation mortgages, which should be more aptly named shared equity down payment plans. These tools, which have been successfully piloted for low-income families in some Canadian cities, should be considered for helping first-time homebuyers get into entry-level housing across the country. The final factor affecting affordability is, of course, house prices. Mortgage rules that limit access may reduce the buying power of home buyers. And we need to, what is needed are actions to reduce the upward pressure of house prices so that more first-time buyers can qualify. To address this, we need to understand what is driving those prices up, and we have what we call the new fundamentals. At the top of that list is lack of supply of family-oriented housing. Simply put, municipal and provincial zoning and regulatory restrictions in our major urban centres have dramatically reduced the amount of service land available. In the GTA over the last decade, the number of newly built single detached homes available for purchase has fallen dramatically. GTA price trends reflect this disconnect between what the home buying public wants and what is available. With high levels of immigration and significant increase in the birth rate over the last decade, our largest cities have a serious shortage of family-oriented housing. CHB estimates that at current development rates, Canada will be short over 300,000 of such homes in the next decade. Governments at all three levels need to work together to address this problem. So long as demand is outstripping supply, our most successful economic centres will continue to see price pressure and falling affordability, and this is a simple law of supply and demand. These are issues that need to be addressed in the National Housing Strategy. The current What We Heard report from CMHC is focused almost exclusively on social housing. While social housing is very important, it's only part of the story. The final National Housing Strategy needs to address market rate housing where 94% of us live. If we don't fix affordability, we have no chance of meeting the social housing challenge. We are at a crossroads where homeownership is concerned, and affordability is at the crux of it. But there's lots we can do to address this challenge. We look forward to working with the government to make it happen to the benefit of all Canadians. And we have submitted a more detailed report that I hope you get to have a look at. And we're here for questions. Thank you.
Thank you, sir. The final presenters are the Nova Scotia Home Builders Association and Sherry Donovan, the Chief Executive Officer. And Sherry, all three of those presenters were exactly 5 minutes and 30 seconds. So.
All right, I'm on it. Okay. And Tamara Barker-Watson will be sharing my time with me, so we'll be diligent of that. Good evening, Mr. Chair and committee members. My name is Sherry Donovan, and with me this evening is Tamara Barker-Watson. She's our president of the Nova Scotia Home Builders and also the owner of a 20-year new home construction company in Halifax. So thank you for our invitation to appear. The issue today is of great importance for us in the Atlantic provinces, which is where we'll settle most of our presentation on this evening. We'll be talking about the impact the new mortgage rules stress test is having on the Eastern Canadian economy in terms of how it affects home ownership for young people and the impact it will also have on seniors. We also feel that having one set of rules for the entire country is not the best solution when it relates to housing. We understand that this is about mitigating risk on a large scale across the country. However, what has been achieved is that through this mitigation of risk, there has been cause for great concern about the stress test and the impact these changes will have on the regional residential construction industries that are in decline in the Atlantic provinces. We are still in deep recovery mode from the weak economy, and this is being done at a time when we just cannot afford to have it happen. And in actuality, these new mortgage rules are exacerbating the problem by hurting the entire economy. For example, from an economic standpoint, in Halifax, we went from over 1,000 new single-detached housing starts in 2009 to as few as only 400 last year, and these starts in Nova Scotia continue to remain below the 10-year trend of 900 units according to CMHC. Further to these declining numbers in Halifax, this same situation can be felt all across Atlantic Canada. And when you couple it with the new mortgage rules, this is significant. One testimonial I feel is important to share is from a mortgage lender in Newfoundland. Only a week after the federal announcement, they shared that they would see an even further decline, and they estimate that 25 to 30% of the clients they had had in the past few months would have not qualified under the new guidelines. And as well, one Newfoundland builder also went from 50 home sales on average between a typical October to December season to 0 this past October to December after the new rules came into effect. This is huge. This is not a positive outcome for Atlantic Canada or the entire country. What seems to be a barrier is there are the same rules from coast to coast. We are aware that indebtedness of Canadians is a serious issue, but the unintended consequences that have spun out as a result of the new rules have created winners and losers. Atlantic Canada is coming out on the losing end of this equation. This is one of the key reasons we feel that regional rules would be a better solution for Canadians. Let's look at two specific groups in the home ownership equation: seniors and first-time homebuyers. The new mortgage rules prevent many young people from beginning asset accumulation, as many are unable to qualify for a mortgage under the new rules. In addition to the first-time homebuyers being at risk, the unintended consequence is that it will also have an impact on the seniors market. With reduced buyers seeking to purchase homes, seniors will be less able to access equity built in their homes and will create disruption in terms of their retirement or downsizing plans. This is a concern for us where the demographic of seniors is higher in Atlantic Canada than any other area in Canada. Mr. Mayor?
If we can focus our concern on first-time homebuyers, what seems to be missed is the benefit of building equity in a low interest rate environment. When interest rates are at their lowest, the biggest proportion of your monthly debt service goes towards the principal amount of that mortgage. The consequences of these new rules is restricting home ownership growth in Atlantic Canada, and also ensuring that when people do buy in the future, they are paying much higher interest rates. My example, as a builder and a real estate agent in Nova Scotia, the impact it's had on my business is huge. The Friday before the new home mortgage rules were introduced, I met with a young couple who were going to put an offer in on one of my new energy-efficient homes in Bedford. They were excited about buying their first home. But when we met on Monday, they no longer qualified. The result? They chose to sign up and rent for another year and bought a new car instead. They are not even sure that under the new rules they'll be able to make home ownership a reality in the next several years. This not only impacted the young couple, but also my business. The loss of revenue from the sales impacts how we move forward as a company in the future. If this trend continues, we will continue to lay off employees and can no longer afford our subs. This is not good for an already slow economy. If you're going to put more restrictions on young people taking on debt from buying a home, why not restrict them from buying a depreciating value like a car and create a forced savings plan for them so they will actually be able to save money for their new home? I also want to draw attention to a statement we made in the Globe and Mail in regards to this issue, that if first-time homebuyers default on their ability to pay their mortgage at the same rate as the general public, which is less than 1%, then the government has decided to protect young people from themselves is more important than giving the remaining 99% a chance at home ownership, which represents the largest percentage of household asset wealth in this country. This will limit access to new home ownership and the benefits that come with it. We appreciate the opportunity of being here today, and we advise you to take action on our recommendation for regional housing rules. And we have lost so many builders and potential homebuyers in the last few months in Atlantic Canada that it's staggering. Thank you.
Thank you all. So we will start with questions, and we have time that the first group, will be 7 minutes each, and we're going to start with Mr. Sarai.
Thank you, Chair, and thank you to the guests. I'm from Surrey, British Columbia. My riding is heavily dependent on the construction sector. Real estate is hot in British Columbia, as we all know. So this is a very important and dear subject to me. So my question is maybe to Mr. Charles first. Of the CMHC-backed mortgages, what is the percentage, and CMHC or insured mortgages, what's the percentage that are first-time home owners, and what's the percentage in relation to the, and what's the percentage of repeat homeowners? So people are buying their second or third home, but still having it insured.
Okay. To answer the question, and thank you very much for it, virtually 90% of our business is the first-time home buyer, and we define that first-time home buyer as someone who doesn't put 20% down payment. So they are the first-time home buyer that we provide insurance to. Now, they may move on, they may sell their property, and they may not require mortgage default insurance in the event they move up and are able to put the 20% down payment. So I would characterize our consumer profile is very much that first-time home buyer. They may stay with us they may stay in that property. Our coverage is for the life of the loan. But if they were to move on to a different property that doesn't require mortgage default insurance, they would no longer have a need for it. But the majority of our business, sir, is very much the first-time home buyer market.
Unfortunately, the way you characterize the definition of first-time buyer is not the definition that, say, most of us would take it as. A first-time buyer is the person who's buying their actual first home. I'm trying to get a number, and I haven't been successful even from other places, to get the number out of the CMHC or secured mortgages. What is the actual percentage of people who actually buy their first home, similar to those that would get a rebate, to those that would be eligible, so they haven't owned a home in the last 5 years and they're not buying their second home?
Yeah, sir, I can't give you a precise number. I would take the view that as it relates to the insured industry, and I only talk for Canada Guarantee, is that the overwhelming majority of purchasers that we're providing insurance for would be first-time home buyers. Okay. But I can't give you a precise percentage.
Mr. Finnegan, you had said that the average mortgage debt level of a first-time home buyer is approximately $300,000, I believe, and $753. Was that you? Or,
no, that wasn't me.
Oh, back to Charles. Okay, Mr. Charles, you had stated the average debt level of a first-time home buyer was $300,000, which is similar. I think $265 or $1,000 is what I had heard, but $300,000 is very close. They have high average scores. But are you concerned about the overall debt load of a young couple combined with their other credit card and other debts?
It certainly is a factor that we consider, the overall debt-to-income ratio. It is a metric. It is a consideration. But I think what I would want to share with you, sir, when I mentioned the average credit score being 753, if you look at that in the context of where that was 5 years ago or 7 years ago, so if you go back to 2008, 2009, that average credit score was closer to 700. So we've seen over the intervening period of time a significant strengthening in the quality of that first-time home buyer. And that's what I'd want to communicate to you, sir.
Thank you. And what is the average monthly payment of somebody who, say, has a $300,000 mortgage? Just off the top of your head, would you?
On today's current rate, it's if they're putting 5% down, off the top of my head, sir, it's probably in the $2,000 range.
And would you say that's consistent, or if that person was renting for the equivalent property, or would that be a higher or lower?
It really depends on the location, sir, to give you a comparison between the cost to rent and the cost of paying the mortgage. And as I think about that, $2,000 may be on the high side if it's a $300,000 mortgage at the current rates.
Okay. And do you think the new mortgage rules are beneficial? I know you had some criticism of them, but...
Yeah. I take the view, and Canada Guarantee takes the view, that the successive measures the government has taken over the years has been a net positive. We support the concept of a stress test. We think that's appropriate. We think that's prudent. We could debate whether the aspect of this, how many basis points above today's mortgage rates would be appropriate, whether it's the current 200 points or 100 points, but I think that's a different type of debate. So we take the view the stress test is prudent. We would remind the committee, though, that the stress test is being applied only to the insured marketplace as opposed to the entire marketplace. So it's that level of prudency is being applied to about 30% of the marketplace.
And how long do you think you should monitor the new policies? I'll give you an example. British Columbia implemented a 15% foreign buyer tax less than 6 months ago, or just around 6 months ago, and already they're amending it to allow people with work permits to be exempt from that 15% foreign tax. So I'm just wondering, they seem to be very either knee-jerk in reacting and then very quickly falling back, or do you think is it a test of how the economy is going, or what are the metrics or tests that we should use to monitor the current mortgage rules, particularly stress tests?
Yeah. I think we take the view, sir, is that certainly through 2017, we need to understand how these changes, which they're certainly not immaterial. In fact, they're quite significant. So from a timing point of view, I'd certainly like to see the rest of 2017 play out. I think you need to look at a number of different metrics, the number of transactions, what's the impact on the rate of home ownership, what's the impact on house prices. You heard from some of my colleagues on the panel that there's distinct regional considerations. The fact that this is a national lever, a national policy lever, I think can be very problematic when you look at the different marketplaces. There's Toronto, there's Vancouver, and even Vancouver's starting to show some softening. And then there's the rest of the country, and the rest of the country is behaving in a much different way as opposed to those major urban centers. So I would like to see at least a year.
Thank you. Move on to Mr. McColman.
Chair, and thank you, witnesses, for being here. First question is for all the organizations, each one. Prior to the October changes that the Minister of Finance announced, were you consulted, Nova Scotia Home Builders? No. Were you consulted, Canadian Home Builders? Your firm, sir?
No, sir.
Your firm?
No.
Okay. So, if you'd been consulted, you might have been able to advise of some of the things, of the unintended consequences or the consequences you've said as you're witnessing here tonight, to kind of see a shake of heads that maybe you would have introduced some of those things as possibilities. Thank you. Let's move on to the affordability issue. Every time costs get added to a house, that is to the consumer, when they accept the key as they move into the house, every time there's a price bump on it, how many people first-time home buyers are taken out of the marketplace? Does the Canadian Home Builders have any statistics on that, Mr. Finnegan? Mr. Burgraff?
Sorry, thanks. Our data is a few years old, and we're actually in the process of updating it right now. But it was for per $1,000, it was about 6,000.
6,000 people per $1,000 of increase in the price of a house.
Yeah.
Mr. Finnegan, over the course of your business in the GTA, you said you're a builder and a developer. What has been the single the largest increase over the years you've been in business to add to the price of a house?
It's all land related.
Say again?
The biggest cost increase has been land.
Land, okay.
Yes.
And is that because of the lack of availability of land?
That's because of the lack of availability of land, yes.
And what does that do to, sir?
Well, we have, Toronto, the GTA is a recipient of a lot of immigrants, and if we can't get land, there's a lot of people competing for the same piece of land. So the price has gone up exponentially in the last.
Why isn't there more land?
There's not more land because of, in our case, of provincial and local policy on land supply.
Land supply for building on. Has decreased.
Dramatically decreased.
Reasons?
The reasons is that the provincial government decided to jump into the land planning process in a much bigger way, and by doing so, basically stopped the normal series of events for about a decade.
Government regulation, fees from the time you have a raw piece of land to the time the key is handed to the owner, the house is finished, they're moving in.
Yep.
Government fees, regulations, taxation, regulatory schemes, etc. What percentage of the price of the house, on average, I've heard some different averages. So we've had different groups come in front of this committee and other committees over the years, tell us it's a different amount. And could you give me a sense of what an average might be?
Well, maybe I can look at it a different way. 5 years ago, for the product I'm delivering today, the land and the fees and everything else would have probably been $300,000 less than what I'm delivering today. So if it was an $800,000 house, I could have delivered that house for $500,000 5 years ago.
So you're talking about a $300,000 increase in government-imposed regulation, taxation, and fees in the course of 5 years in the Toronto market.
Yes.
This is astounding to me because this is something at all three levels of government, including this level, don't seem to understand. They see you as a rich builder, rich developer, making all kinds of money because you're selling houses, right? I've been there. I've been at council meetings. I've seen it. I've seen it at the provincial level, and I've seen it federally as well. And they think that that housing, new homes especially, can be a cash cow because it's kind of hidden. There's nobody out there really, other than the home builders in each community, speaking up about it. So I would suggest to you, one of the affordability problems we have in this country, and I want to know whether you agree with me or not, is the fact that more and more government costs, government-imposed costs, and they cost the Board of Fees, regulations, taxation, etc., especially development charges. I heard of one development charge. Tell me if this is correct. I believe it's Markham or it's one of the GTA communities. That's $56,000 per unit.
Oh, that's not the highest one.
Which is the highest?
We're in Brampton and Caledon area now. We're looking at $85,000 to $90,000.
$85,000 to $90,000 a door.
Right.
That's just development charges.
Just
That's
development
just get your shovel into the ground.
Correct.
Okay, so you know where I'm going here because I'm getting quite excited about the fact that if we want to address the affordability problem, let's address what's causing the huge increase in housing, which in large part is government imposed at 3 different levels. And this is one of the levels we're dealing with here today. Not so much. We're probably, as a federal level, the smallest slice of that piece of the pie. But the reality is every time you exclude, you add to the price of a house $1,000, 6,000 more Canadians can't buy. So we wonder why we have a housing problem in this country, why we have people lined up for social housing who can't afford their first house. Now, in your business in the Maritimes, interesting. Thank you for coming, by the way. It's nice to meet you. With your business, you were describing the situation where you've had to lay people off as a result of your business, not having these things because of some of these changes and other changes. What is the single most important thing in your mind in terms of affordability?
Well, even in little old Halifax, we've got between about 27% of our home prices is taxes, development charges, levies, water and sewer fees. So we're on the low end compared to Toronto, but we still have quite a bit of fees and taxes. I would say right now we don't have any buyers that are entering the market. Therefore, I don't necessarily sell. As a real estate agent, I sell to first-time home buyers. But as a builder, I can't necessarily build anything that could accommodate a first-time home buyer price-wise because of the cost of land and things like that. But we have nobody entering the market buying Bob and Mary's bungalow so that Bob and Mary can move into their dream home that Tamara built them. So we have nobody entering. So the choo-choo train chugs along, and then we sell Bob and Mary a new home, and then the people that were in this home move out to and buy a condo and retire happily in a condo. So we have nobody going into the market.
Thank you to both of you. I know that every member can question probably for a fair amount of time, but we have to stick to the rules. Mr. Caron.
Thank you very much. Merci. First question, actually, as a follow-up to what Mr. McColman asked. Are you usually consulted on changes to the mortgage regulations? Like, there's been quite a few in the last 10 years. Are you, or your organization, of course, consulted usually beforehand?
Yes. In the majority, I would say so, at least to a certain degree, if not very specifics, but at least an idea of where they wanted to go and what our feelings were on it. I will say that in the October changes, immediately after they came out, we did come. There were some some issues, especially with people who had contracts and how that would transfer over, that the department then worked with us and reissued some of the rules to fix those deficiencies.
Is that the case for the other organizations?
We were not specifically consulted on the changes in October. I would say, though, we have excellent dialogue with the Department of Finance, and we talk to them on a regular basis.
Just to be clear, I'm not asking if there is like lobbying or discussions, like specifically when the government considers moving towards a change in mortgage regulations, lately more constraints. There's been changes in the last 10 years, in 2008, 2010, 11, 12, twice, and 16 more recently. So I just want to know the modus operandi of the department. Are you consulted before the announcement of those changes?
I would characterize it as follows. There's no formal consultation period, i.e. there's no published document that welcomes input onto it. I think we take it incumbent upon ourselves to make sure we're in front of the Department of Finance officials to try to gain insight into their most recent thinking. But there's been no, to my experience, I've been in the role now since 2006, I don't have a strong recollection of any formal documentation requesting input. I do think it's incumbent upon the industry to maintain a dialogue with the finance department, but no, sir, there's been no formal communication.
Okay. Then most of you, like most of the other groups we had in previous panels, seem to be opposed to the last round of changes. Fair enough. There's been, as I said, quite a few changes in the past, like the reduction of the amortization rate from the length from 40 years gradually to 25 years, the decrease also of the level of refinancing that's possible from 95 to about 80%. Were you opposed to these changes? Why are you so opposed to the last changes compared, for example, to those previous changes that took place? Anyone?
I think we were certainly, as I indicated in my opening comments, we were supportive of the fairly extensive changes that you referenced from 2008 onwards as strengthening the housing market. And in fact, I think have created a lot of positive dividends for the housing market. As it relates to this most recent changes, it's the level of impact. These particular changes are impacting the competitive structure of the housing market. And when I say that, the mortgage lending market. And when I first started in my role, sir, the first-time home buyer was at least in the 40% of new mortgages, and with some lenders as high as 50%. I think we take the view that it's been the cumulative impact of reducing the first-time home buyer, and this may have been a bridge too far, this most recent change.
Okay. Go ahead.
I guess I find these changes came without any consultation, and it's eliminating the ability of the insurance or mortgage refinances. That's a big part of the business. So it structurally changes the lending industry from a model where Canadians have choice, and they're further concentrating the lending business back to the DSIBs, which is a significant change, a big structural change.
So you both bit. I'll ask you the following question. Obviously, we know the situation in some local markets, especially Vancouver, Toronto, and Regina as well. What could the federal government have done differently? What should have been the federal government's prescription to prevent or to reduce the overeating in those markets, while not affecting the other markets and having those adverse consequences that you talked about?
Well, I guess here's a couple of options that they could have done. If they're concerned about liquidity, too much liquidity in the marketplace, how about increasing the qualifying rate on the 70% of the market that is conventional mortgages below 80%? If you want to reduce liquidity in the marketplace, what about increasing the down payment that people have to have on mortgages, on conventional mortgages? Certainly that was the case prior to 2007 to the last amendments in the Bank Act. That would be one option. certainly taking away the ability of Canadians to have other options is very anti-competitive and doesn't help Canadians achieve their dreams of home ownership. So there would be a couple of options.
Yeah, I would echo that, and I would add, when we talk about the qualifying rate for precision, we're talking about the stress test.
Yep.
And the application of the stress test, not just on the insured marketplace, which, as I said, is reducing, but the government could have considered or contemplated the stress test overall being uniformly applied to all mortgages. As I said, I think we've been very supportive of the concept of a stress test. The reduction in amortizations, we're very much supportive as well. The way I would try to frame this for the committee's benefit, the committee's reference point is these changes are disproportionately impacting the first-time home buyer who's not creating any froth, any challenges in the marketplace.
The $300,000 average insured loan is not that's not the loan in the GBT, Greater Vancouver or Toronto. It's the loan in Calgary. It's the loan in Rimouski. It's the loan in rural Ontario. It's the loan in Ottawa, Gatineau. And to put the stress test on that's not the place to put the stress test on. Should be putting the stress test on in the big homes and the big amounts in the big urban areas.
All right, thank you. Mr. Connell.
Mr. Chair, thank you for coming. I'm going to start my questions by following up, actually, Mr. Smith and Mr. Charles, on the points that you were just making in terms of competitive structure. I find this interesting and something we haven't actually talked about yet. The government, essentially, what makes it different for your organizations versus, say, the banks, is the fact that the government support in terms of public mortgage insurance. If we're at about 58% compared to, in the United States, 14%, United Kingdom, 0.4%. If we were to change that model and not insure and back those mortgages, could your business model actually function without this high level of government support that's already provided to your industry?
Sorry, I apologize. Is that a question for my benefit?
Well, I think you said, sir, these regulations, your biggest concern, you supported previous regulations, but your biggest concern is about the competitive structure and that choice. However, the government, in substantial amounts compared to other countries, back and support your industry through backing the insurance of these mortgages. So if we didn't do that as a government, like I said, in comparison, 58% compared to 14% in the United States, could your business model structure even function and exist if we didn't heavily support your industry already?
Yeah, I think I take the view that the government's participation in the housing market has been a net positive for Canadians. And by virtue of owning 100% of CMHC, I mean, that is a public organization. That's 100, and it's an organization that some of the testimony up here people have indicated has been a very positive for the industry, and I believe that. But by virtue of owning 100% of CMHC, I'm going back now probably 15 to 20 years, if not longer. The government at the time wanted to encourage some competition to provide Canadians with choice.
Sorry, I only have limited time, so I'm not trying to cut you off from hearing what you have to say. But my question was in regards to if the government did not support through backing of this insurance, could your model function without the government's substantial support?
It would be significantly challenged if the government continued to own 100% of CMHC. If the government wished to exit the mortgage default insurance and withdraw that government sponsorship, we could compete quite effectively on an apples-to-apples basis.
Thank you. So I want to move quickly because I don't have much time. I want to move to the conversation that was had with my colleague Mr. McColman in terms of land availability supply. Mr. Finnegan, being from the GTA, I understand your point. I'm going to make a quick statement and then get to my question, but in terms of development charges being high in these areas, I guess my rhetorical question, and perhaps Mr. McColman can think about this, I'm just curious because development charges that go to municipalities that support new homes, what should municipalities no longer supply to bring that cost down? Should we no longer build fire stations? Should we no longer build police stations? Should we no longer plow snow? Should we no longer collect garbage? Because those are exactly the things that actually are used to support those development charges. So in terms of getting to my question to Mr. Finnegan, I'm just curious, you talked about land supply, and the GTA I know well, so I want to ask this question. Without those government regulations and the control, because it's not saying you can't build anymore, it's saying you need to build higher density, you need to have better land use planning. Because what happens when the day comes that you pave over every piece of farmland, you pave over every valley and creek and stream, and eventually the land actually runs out? I'll tell you, land runs out, then you get into water if you're going to build communities on water. Mr. McColman, I mean, that's a different conversation. But is the suggestion just to forget that regulation so that future generations are built out and there really is no more housing for anybody? Or is the government regulation really to have better land use and better building and design to also bring into better efficiency of services?
In terms of land use and planning, there absolutely no argument from the building industry as to what land use planning is, the direction we're taking on it, which is much smaller homes, much better use of the land, more sustainable product being built, things of that nature. Our problem is that the land is not available to build on. The designated lands that have been earmarked for development by the provincial government in the GTA are not physically available in a timely manner to the industry. It's not a matter of us taking any more land or using it any more efficiently. It's just not available. The pipes aren't there, the roads aren't there, the approvals aren't there. The land's sitting there ready to go and approved, and with densities that we all agree with, the new round of the Pollock province, I'm not so, but it's just a matter of access. And the 10 years it took to get that program in place put a huge dent in the supply for that long, and you just can't make it up by continuing to have a program that moves at 30% speed when it should be moving at 80 or 90% speed. And again, we're not using any more land, and we're not, than's already been designated. We just can't get to it in time.
Thank you. So I guess my question is that really an issue of government regulation or market control by a few really large developers? There are going to be 70,000 new homes in my community, but guess what? They're being built by a handful of developers. So is it really government regulation in terms of availability of land, or is it market access through some companies that choose to pay a higher price because they just want to build? And I would think that's a very conservative mentality, free market in terms of what the access, but I think in terms of where the land is available and ready to go, the issue is that perhaps smaller developers are not getting access because there are very large development companies that are buying it up before it opens up to the larger market.
That process of land holding amongst very few large developers is something that's been going on for 50 years in the GTA. The land availability, the rate at which it is actually being brought to market, if there's any cases at all, it'll be very few. Every developer I know, including myself, the only way we can proceed on to our next development is to proceed with the development we currently have. And we can't get to them. My example, I bought a piece of land in 2003, supposed to develop in 2006, 7, 8. Growth plan 06, I was delayed till 16. May of 16, I'm not going to deliver the final house in that development to 2020. Do I want to wait that long? Absolutely not. It impedes my business, my ability to buy future sites and everything else. It's 100% as a result of the government policy that was put in place in 2006.
All right. Thank you. And we'll move 5-minute rounds to Mr. Elvis.
Hugely ironic, Mr. Chair, that we have someone who is saying that big players shouldn't be able to dominate, but that's exactly what this policy is doing. It actually is making the market less competitive. And if we had a completely free market in your area, you wouldn't have a situation, because you'd have small firms, there'd be lots of competition, but because of the ongoing taxes and regulation, only the big players can play. And that's what I'm afraid, Mr. Chair, is happening in this case. We're actually going to be weeding out large amounts of maybe they're considered non-traditional, but they have supported a lot of Canadians to get into their homes. And remember, 69% of Canadians enjoy that right, and we've heard that the rest, maybe for the 6% that are waiting for social housing, want to join in. They want to have the benefits of that home ownership. So it's interesting to see that that they want the benefits of competition, but they don't see that this policy right now is reducing it. So I'm going to go right into it. I'd like to ask first the gentleman from First National. So on my point on competitiveness, what do these new federal measures do to groups like First National, who I guess again for non-bank mortgage lenders?
So I would say there are two changes, and I think the biggest change that weren't particularly in the October regulations, but were the changes announced by the Superintendent of Financial Institutions in mid-November, increasing the mortgage insurance premiums on loan to values below 80%. We compete directly with the Schedule I banks, and we've competed on interest rates. So the first change that the minister made was we can no longer provide refinancing on a borrower comes to us and it's a refinance loan. We can no longer purchase mortgage insurance. And the double whammy, and it almost makes the first one irrelevant, because the superintendent increased the capital that mortgage insurers have to hold to 2.5 to 3 times, 2 to 3 times the similar amount of capital that a bank has to hold. So the mortgage insurers just increased all their insurance premiums, and they've increased to a point that we can no longer afford to pay those premiums. And as a result, we're not competitive with the Schedule I banks any longer. So it's probably eliminated our ability to deliver a competitive mortgage product in the conventional space any longer.
So the credit union said something very similar, because
this would be a very similar message. I reviewed their testimony this morning from Monday night, and I think it's a similar message.
Okay. Now there seems to be a lot of consternation on the stress test, not the idea of it, but to me, the fact is someone either qualifies as a low risk or they don't, and that's something your industry has done quite well. In fact, we've heard testimony saying that traditional lending and non-traditional both have very, very similar rates for defaults, which to me says that everyone's doing their homework to make sure that no one gets loans who cannot afford to pay them. That being said, do you have anything specific that you'd like to mention in regards to those changes or any future changes?
Yes, I would say my view is I'm not nearly as fussed about the stress test as maybe some of the people that have appeared. I think there's a lot to be said that if you're taking a mortgage out at 269, you should be able to handle an increase in interest rates. Maybe not 200 basis points, but maybe 100 basis points or some increase. So I think it's appropriate. I think what I can't understand is why you applying it just mainly to first-time home buyers. If we're concerned about people having stress, why are we only doing it in 30% of the market that's insured? Why aren't we doing it for the entire market? Why is not OSFI bringing those rules in for people who are borrowing $1 million or $1.2 million? They're going to have the same type of stress in 5 years, yet that doesn't apply to those people. So you still have 70% of all mortgages now that are qualifying at the contract rate, And then first-time home buyers are now being contracted at the Bank of Canada rate. It seems inconsistent to me.
Okay. So when it comes to talking about putting more of the risk onto the private sector vis-a-vis what Ms. O'Connell was mentioning, that's a policy choice. In Canada, we've always taken the policy route that we want to make costs as efficient as possible so as many people can own a home. That's part of the Canadian dream, so to speak. Again, 69% of people very successfully done that, build up a lot of equity. So in regards to that, any future changes, that to me would say, okay, if we're going to do it by private, if we're going to bring it to the private sector is going to say, okay, if there's added risk to it, then we're going to price that in. Will that make ultimately the market more expensive and not just less competitive, as we've heard? And this is open to everyone.
Well, I'd just like to comment on the issue of the. I think there's this view that somehow the government's backing all the mortgage insurance, and I'll speak for the mortgage insurers. The two private mortgage insurers have capital to support their obligations to a AA level. This is comparable to the capital level of the Royal Bank of Canada. I mean, it's a very, very strong type of covenant. So the shareholders have put the money in and they've collected premiums, actuarially determined premiums, that they can handle those liabilities. In fact, OSFI has increased the capital that mortgage insurers have to have in their businesses by 40 to 50% in the last 5 years. So these are very well capitalized businesses. This government backstop guarantee steps in only when these AA institutions have gone bankrupt. So it's very comparable to CDIC insurance.
Okay, Dan, I have to stop you there. You're way over. Mr. Fergus.
Thank you very much, Mr. Chair, and thank you all for coming today. I'm glad that you've been able to be here. I hope I would, if I had more time, I'd be able to ask questions of you all, but I'm going to just try to focus in a little bit onto some of the things, and just to help me understand where we're at. Mr. Charles, you had indicated that it would, and also Mr. Smith, you both indicated that it would be inequitable, that the stress test would apply only to insured mortgages. So if I could just take it 2 steps back here, is it a good thing for people to put down to have conventional mortgages? What is the benefit of having conventional mortgages, in your opinion? Is it a...
Well, the immediate, for conventional borrowers in Canada, there's no insurance premium they have to pay. So I think that would be an immediate benefit. I think what we're trying to suggest that if the stress test is an effective tool for first-time home buyers, and the first-time home buyers now represent only somewhere between 30%, potentially 20% of the marketplace, is the government regulations more effectively applied from a point of view of moderating the housing market if that same stress test is applied on the conventional business?
Let me take this from another perspective. Sorry, Mr. Smith. Are the folks who are able to put down a larger down payment on their home a more secure client? Are they more resilient to any what they call exogenous economic events?
Yeah, they certainly have more equity in the home. I wouldn't necessarily say that the strength of the borrower is fundamentally different between a conventional mortgagor and a high ratio mortgagor, but certainly in the event of default, they have more equity in the house.
So then, can you walk me through then could you walk me through the concern that you may have over applying that stress test to not first-time home buyers?
I would only take the view that at a macro level, sir, the first-time home buyers segment has continued to be diminished and represent a smaller component of the overall housing market. It just strikes me if it's prudent for one part of the housing market, that's not necessarily creating any of the challenges in today's housing market, being the elevated pricing in Toronto or Vancouver, because that's largely not a first-time home buyer market. It strikes me as at least a prudent consideration to contemplate having the stress test on all mortgages in Canada.
You would obviously want your clients to make sure that your business model is you want the smallest default rate possible, of course.
100%.
That's right. So again, if you have a client that who is seeking an insured mortgage, they have a higher debt to income ratio. Aren't you concerned that if something were to happen, the markets change, interest rates go up, that puts your business model, your business at risk with a higher default potential for default?
So the first-time homebuyer market, the insured segment, I want to talk a little bit about the due diligence that's undertaken. It's essentially a dual underwrite that happens in Canada with the lenders underwriting the first-time homebuyer, and then secondly, the mortgage default insurers doing a review and re-underwriting the file. I referenced earlier a credit score, an average credit score of 753. Contrast that to 7-8 years ago, the equivalent score was about 700. So it's a tightly regulated marketplace. It's a tightly underwritten marketplace, and frankly, it's performed quite well over the last 10 to 20 years. So I'm entirely motivated to have zero default. I'm economically motivated to have zero default, sir, and I think it's a particular segment that has performed well. What would cause that to be differently would be unemployment, sir.
Sorry, Mr. Charles. I certainly don't want to cut you off. It's just that I know that the chair is not going to let me go too much longer. Have the ability to has the method to assess credit scores changed over the last 7-10 years?
Thank you for the question. The credit scores there's two providers for credit scores in Canada. Both have made significant changes in their credit scoring capability, their algorithms over the past few years.
So, again, I'm not saying that that's not has it changed in a way that we're not comparing apples to apples when we're taking a look at credit scores today as opposed to credit scores 10 years ago or when I got into the market in 1995?
I would say for the purposes of comparison, it still is apples to apples. I mean, there's been nuances, changes. 15 years ago, there may not have been cell phone, the same degree of payment history for your cell phones that have now been incorporated into the scoring model. So the level of sophistication continues to improve. But I would be remiss if I didn't remind the committee that as a result of the various interventions and overall industry tightening, that quality of that first-time home buyer has never been stronger.
Thank you. Mr. Kelly.
Thank you. We've heard testimony from, I think all of our witnesses today, and certainly from other witnesses and other people concerned that there really isn't any such thing as a national housing market. A national housing market is a collection of local markets with local factors and local challenges. The consternation and hand-wringing around housing seems to revolve around two markets in Canada, and yet the most recent changes to mortgage qualification have been across the board, and as was already asked by my colleague and established here to have been done, it would appear without any consultation to the largest non-bank lender in Canada and one of only 3 providers of mortgage insurance. I'd like each of you to quickly comment on whether you think, and I would like you to be quick because I've got a follow-up question, quick about are there not ways that local concerns over local markets could have been a different approach to be taken by the department?
That's a tough question to give a quick answer to. I suppose you could have a bifurcated market with various top-up and loan amounts that would be insured, as was the case 20 years ago.
I think it's very challenging from a national perspective to have a national policy, and I think I would certainly much prefer to see regional solutions.
So yes, it is the application of rules for houses that are over 500,000. That would help the regional diversification and as well as first-time buyers who are typically below that level.
I would have to agree with Jason. There are 34 prominent markets in Canada, and this rule was done to cool down 2. So the other 32 markets are suffering.
Hammer to crack a nut, right? So we're just applying it to everyone. So I find it's really difficult to, without the regional differences. we suffer, and not just Atlantic Canada, but all the other markets outside of the two areas.
Indeed. So the stress. Sorry, go ahead, Mr. Finnegan.
No, I'm fine.
Okay.
Jason answered.
The stress test, which we've had mixed reaction, and some are perhaps more concerned about the result of it than others. But would that not be a way? There was a time in the and I was in the mortgage industry and for over 20 years. There was a time where the debt service ratio requirement was different for a first-time home buyer than somebody that had not. There was, for many years, CMHC had a higher threshold in recognition that a first-time buyer is likely at a stage of life where they're more probably going to want to and be willing to struggle to get that initial toehold in real estate and be able to grow into that and likely to have increased incomes. Would perhaps either a debt service ratio that could be adjusted for first-time home buyers to protect that group, or to look at regional issues and perhaps have regional qualification to deal with regional concerns that Canadians have?
I take the view that when you think about debt servicing ratios, the stress test serves the same purpose. It's a little bit of 6 of one, half dozen of another. So whether you pick the stress testing or you work on debt servicing ratios, it achieves the same output. I think the challenge when you think of some of the solutions that are national in scope, it just doesn't work for half the country, if not more than half the country, and it's very challenging.
Yeah, I think if you're looking at debt stress, I'd have trouble to say if you're putting the debt stress in, if you think that's the appropriate thing to do, just segmenting out part of the country is not appropriate. I think getting back to that previous answers, maybe you should have different loan limits for different parts of the country, reflecting the fact that the average house price in certain areas are different.
That is another thing that has existed, and we've had that historically, as CMHC used to have different ceilings for different markets, and we've gone away with that, trying to make things universal. Am I out of time?
1 minute.
Well, then I'd like to then maybe get back to the issue of competition and quickly perhaps ask Mr. Smith, as the largest non-bank lender, you've mentioned concern about your ability to compete with the chartered banks. If you can't compete with the chartered banks under these rules, how would one of your competitors in the non-bank, the so-called monoline lending space, be able to compete even with you or to compete with banks?
Yeah, I think it's going to be very, very tough. We have other independent sources of funding which are not available to our smaller competitors, and I think it's going to be very, very tough. It's certainly, reducing choice. It's certainly the recent mortgage insurance changes are a revolutionary change in the Canadian mortgage landscape, something we haven't seen in 30 years.
Higher interest rates then for borrowers?
Absolutely.
Okay, thank you. Final set of questions from Mr. Sorbera.
Thank you, Chair. Thank you, Mr. Leeper. Welcome, everyone, and thank you for traveling from, I take it, from Toronto and Halifax, if I'm not mistaken, and possibly Ottawa here. After 8 hours of this, the first 8 hours, I guess, of the housing study, I think a couple common themes have emerged. And I would say, first of all, that the Canadian housing market is based on a series of regional markets, that there is no uniform market across the country, that a number of participants would like a pause in the measures and any incremental new measures, that that risk sharing to some participants is of grave concern. I'm not saying I agree or not disagree, I'm just saying these are the themes that I've seen. That CMHC, from its original mandate to where it is now, and looking at the 69% home ownership rate in Canada, I think it's about in the high 60s, has largely been successful, especially for encouraging home ownership in Canada and allowing new entrants to enter the home market. And that finally, Canadians are great customers, i.e., we're a great credit. We work hard, we save. We want to save for our kids. We want to save for the future of this country, invest, pay off our mortgage, take a vacation when we can, and have faith that the stewards of the economy and our regulatory organizations are doing a good job, which in large part I think they are. And I do agree with Mr. Charles and Mr. Smith that a lot of the changes that have been enacted, you can quibble about the stress test being 50 basis points higher than it should be or 100 basis points higher than it should be. That's not really the issue. The issue is ensuring that Canadians have access to the home ownership market and to buy a house. So my one question with regards to the pause, and specifically to Mr. Smith and Mr. Charles, you both gentlemen have been in the market, in the housing market for a very, very long time. I'm not trying to date you, but I'm just saying I know you're very well respected within the industry. How long do you think we'll have data that we can see and on a qualitative basis determine what is exactly going on?
Thank you for the question. As I may have mentioned earlier, I think we want to at least see a full year going through the cycle to truly understand the impact. I've got early data, but that's really just two months worth. That is a relatively modest sample size in terms of the impact. But I would encourage members of the committee and the government to take seriously that pause, as you position it, to reflect. And again, it's the cumulative impact of the changes, not necessarily one specific aspect of it.
Yeah, I think at least a year to 18 months. We have data from January already. I think you can get seasonal effects going on. Markets may be slowing down in any event, so I think you want to have at least a full year, if not longer, to try to get a sense of what's happening in the marketplaces before you do anything else.
Of course. Time for one more? To Mr. Finnegan at the Canadian Home Builders. My riding is within the city of Vaughan. We have a number of large entrepreneurs in that riding, both in manufacturing and the home building. And I've spoken to a number of them in the home building, and they generally say, the green belt and the places to grow, that doesn't worry them. It's more the time to get the product on the market that worries them. And the developmental charges, relating to sewer and water infrastructure is needed, and those charges go into the fund, and the debt's paid off after a number of years. But I do want to ask, a little bit of a twinge, the labor supply issue. What are you hearing from your partners and members within the GTA in terms of the labor supply issue? Because I hear that is actually a constraint.
It is a bit of a constraint for constructing and slowing things down a little bit. But our concern on the longer term is it's going to get worse with the shift from high-rise to low-rise housing. The other way around. A lot of the trades have left the low-rise business. So certain trades, most recently carpentry, bricklayers, things of that nature, definitely is causing some pressure on pricing, but nowhere near what some of the other pressures are.
I just have a follow-up question.
Very quickly.
Yes. To Ms. Donovan and Mrs. Watson, what do you expect for housing starts this year in Nova Scotia? Do you see any sort of stabilization? I'm very disappointed to hear that there has been layoffs within that industry in Nova Scotia, but any commentary to any green shoots?
We're definitely going to be down compared to last year. And the last 2 years were probably the worst 2 years on record, and we're going to be down from that this year.
In Nova Scotia, but we're talking Atlantic Canada as well. So there's, from our, from the regional perspective, with the halt pretty much in Newfoundland, and New Brunswick starts are down, and Nova Scotia starts are down, and so I think overall there's it's not looking it's like a blue sky in any way.
All right.
Thank you, Chair.
So that concludes our questions from our members. But Tamara and Sherry, you traveled a long way. Is there anything that you heard tonight from other witnesses that you might want to take a minute to just expand upon before we adjourn?
I just think reiterating the blanket national policy just doesn't work, and I think that it's really important to consider when making decisions what that impacts, what the unintended consequences are, and who it impacts, and that You know, it might only seem like a few jobs, but when I look at, for my builders, I've had 7 major companies go out of business this year. We're talking, one builder had 60 years in family business. So the impact that that had on the community, we're talking at least 50 to 60 people out of work in one very small community in Nova Scotia. And so you look at all of these impacts and how it will flow downhill. So I think it's really important to consider, you know, not just the bigger markets, but to consider the little markets as well and how they add up to a larger number overall. So thank you for the chance to speak.
And it's not just the builder. I need electricians, I need plumbers, I need drywallers, I need shinglers. If I go out of business, most builders are leaving them holding the bag. The suppliers are usually protected by lines of credit or personal guarantees. The banks are all 100% guaranteed. So they'll own my house, they'll own my cottage, they'll own the boat. But I think it really can't be one rule for all of Canada. We are so different down home.
All right, thank you for all the witnesses, and committee, we're done. We'll see you all next Monday and talk taxes.